GetCrack. Wake up, motherfucker.
I guess really goes down as a historic day. An S&P 500 that closed lower by about 1.5% here on the day, 55.21. That's the level, down 6% on a year-to-date basis. But more importantly, it's down 10% from that all-time high set back in late February, February 19th to be specific. That means technically we are in correction, and technically the bull market that ostensibly began back in late October of 2022, a more than 70% run-up in the S&P 500, that bull market is over. Ed Harrison joins us right now, Bloomberg opinion columnist down in Washington, D.C. And Ed, maybe make some sense here of just how much, or how quickly, I should say, this market had flipped. Because we were talking about record highs towards the end of last year and even towards the beginning of this year. We were talking about price targets for the year end in the 6,500 range and beyond, some price targets as high as 7,000, and a lot of euphoria about pro-business policies from a pro-business administration. What happened on the way to that party?
Yeah, I think reality happened there, Romaine, because basically, it was probably mid-February that the jitters from the early parts of the Trump administration really kicked in. I was talking earlier to Carol Masser and Matt about the divergence in the DAX, which is the German index, and the S&P 500, and that's when you saw the big divergence. Certainly from the beginning of the year, we saw that differential, but it really kicked up with the S&P falling from about mid-February, and the DAX really outperforming in that time period.
The recent increase in CPI data has raised questions about its potential effects on other asset classes, specifically the equity and bond markets. Recent CPI data for November, December, and January exceeded expectations, leading to selling pressure in treasury markets and causing equity markets to reconsider inflation prospects. 10-year bond yields reached the highest yields in over a year, topping out at 479 basis points, while the equity markets maintained an upward bias. However, recent data suggests the economy is beginning to slow, and the February CPI reading came in below expectations at 0.2% for both headline and core readings. The shifting dynamics headed into the data have lifted bond prices and moved yields back to the low end of the 4-month range. Due to the push-pull mechanisms in the markets, the equity markets appear to be more concerned with growth and have traded to the lowest level in 6 months. Should the February data be confirmed by other inflation data, it could continue to support bond prices and help stabilize equity valuations.
Christina Parts-Neville joins us now with the details.
Several months, I should say, they've been searching for a CEO. They found Lip-Bu Tan. He's no stranger. He's a tech investor. He's worked at Cadence Design, which is a chip automation software firm. He used to be on Intel's board, but stepped down back in August. Rumors were that he clashed with former CEO Pat Gelsinger. So now he's back. The current, or the co-CEOs, you have David Zisner. He's going to keep at it as CFO. And then Michelle Holthaus will remain the CEO of Intel Products. But I guess that's one bright spot for Intel, given the other issues. They've had product delays with their AI chip. We know the spending. I think they're burning through about $25 billion a year on the foundry business. And then competition. They're losing, continued market share to AMD and even to the likes of NVIDIA at this point.
I mean, it seems that, if you wanted to pick the perfect CEO for Intel at this moment in time, Lip-Bu Tan is the perfect guy, because he's like the anti-Pat Gelsinger. I mean, he left in August reportedly because he clashed with Gelsinger. He said that Intel didn't have a clear AI strategy. Its workforce was bloated. He just disagreed with management style. And so those are exactly the things shareholders want addressed.
Precisely why they're reacting more positively to this news as opposed to somebody like a David Zisner. No offense, like, he's worked with the company, but his background is finance. It's not necessarily semiconductors. And Pat filled that role, but maybe not strategically, trying to do too much all at the same time.
So let me ask you, what is the mandate, do you think, for his CEO-ship? We have lots of discussions of looking to sort of carve up Intel by various buyers looking. Is it custodian until that happens, or is it something very different?
excellent point. I think with the lots of buyers, you're referring to the foundry business and whether TSMC is going to be less than 50% owner, AMD, Broadcom. Those rumors have been I know it came out today. The stocks for all of those shares popped, but those rumors have been milling about for quite some time. It seems like something has to happen with the foundry business. I don't know what Tan's role would be in that case, but something needs to, especially with President Trump really pushing for more help specifically to that business that's burning cash, and they're still not getting the number of customers up there to even compete at the same level as TSMC. Not saying that they can't eventually, and that they have, the know-how and all the wonderful talent here in the United States, but they're still so far behind, and that is a big drag on margins. So it's a possibility of a separation.
Christina, I don't know the answer to this. You may. I mean, they're supposed to report the end of April. Any chance that they sort of in the next couple of weeks come out, pre-announce, kitchen sink, clean slate? We've seen things like that before.
I don't. There's an Intel Foundry Day at the end of April, so I wonder if they're going to hold off on doing something that drastic, given the proximity to the Foundry Day. We probably, there's a lead up. With like NVIDIA, for example, GTC, they waited, or they're going to wait to announce products and stuff like that. So to your point, it may not be beneficial to jump the gun with their earnings report just so soon, given they have that update. They have an AI event this month, but a Foundry one that should be bigger at the end of April.
Intel has an AI event.
Yeah, something I saw more at the end of March, which I'm not going to, but I should be going to the Foundry one because I was expecting some news coming out of that at the end of April. Though.
Right.
So another catalyst for the stock.
Potentially.
Yeah.
Christina, thank you.
Good point.
Christina Partsenevelis. All right, so the biggest overhang in the stock, no CEO. That's now resolved. Courtney, does it look interesting?
Well, I think that's the one overhang, but the other thing is just the foundry business, right? I mean, they're expected to still be showing losses there through 2026, and that's the question is when that can happen. In the meantime, when is that turnaround going to be there? So I would actually still be cautious. I think this is good news, like maybe a reason to dip a toe in. I wouldn't be going in with 2 feet at this point in time.
Where he came from, Cadence Design was one of the most innovative companies, or seen as one of the most innovative companies when he was there. If you look at a stock chart, he's coming in at just the right time. It ran up, dipped, now it'll pop again. It already popped today. I would be a buyer.
Arya is senior semi-analyst at B of A. He's the #1 semi-analyst per Extel. And Vivek, it's good to have you here. Why do you think the market is responding so positively to this appointment?
Thanks, Kelly. We think this is a very smart move by Intel's board. We think Lip-Bu brings a very fresh outsider's perspective to the company. There's a lot of challenges ahead of them in trying to design the right strategy for their manufacturing group, for their product pipeline. There still is no AI pipeline for the company. The manufacturing side is behind. But we think what Lip-Bu brings to the table is a very kind of breadth of expertise around the design side, right? He has worked well with foundries. He was at Cadence Design Systems, so he knows how to work with external tools at Cadence. He did a lot of restructuring. So I think he brings the right level of experience, knowledge, respect, and relationships across the supply chain. But we do think, turnarounds don't happen overnight. It takes a while for really managing something that is so asset heavy. So we just think it's a matter of time, but this is a very strong move by Intel's board.
Does it signal to you that it would put an end to talk about a split up, talk about TSMC and maybe Broadcom getting involved? Could it accelerate that discussion?
Right. We actually think it could accelerate that discussion. Yesterday when Intel's board put out the statement, they said that they really want to have a very strong foundry business and a very strong product business. So in their minds, from what was evident in that press release, they're already thinking about the company in 2 different parts. Today, a lot of the challenges that Intel faces is on the manufacturing side, which is behind, doesn't really have the scale to compete with Taiwan Semiconductor. So they need to find a way, some kind of financial structure that helps to provide some viability to that part of the business. And we do think it's very important for Intel to be a very strong, viable manufacturing entity, not just for the sake of the US, but for the global industry, right? So this way we have diversity of supply. But once they are able to sort of ring fence the manufacturing issues, Intel's fabless business, right, is actually quite decent. They have a good incumbency in enterprise PCs and servers. It's not a super high growth business, but we do think that part of the business will then have fewer problems to worry about, and I think has a short of a turnaround.
So for people who might want to jump into this, your price target's still only at 26. That's not a lot of upside. And while we have you on a day like this, Vivek, with all, tech stocks and chip stocks under pressure, where do you think people could capture the biggest upside right now?
Sure. Kelly, when we look at the space, like any other market, we always worry about the 3 Ps, right? There is profits, there is positioning, there is policy. When it comes to profits, the profitability of the semiconductor industry is exceptionally strong, right? We know that certain end markets like industrial, automotive are just coming out of the downturn. But when it comes to names exposed to the AI side, they are exceptionally strong. Names exposed to semi-cap equipment are exceptionally strong. So I think the profit side is taken care of. The positioning side, in hindsight, was a little heavy. The SOX index was trading at 30 times forward PE. Now it's closer to 20-21 times. So I think a lot of that froth has come out. The policy side, that third P, that is where I think there still continues to be uncertainty. But where we really see opportunity, I think NVIDIA, first and foremost, you have a stock trading at less than 20 times forward earnings, growing earnings over 30 to 40% a year, the GPU technology conference next week. So I think that's a really strong name. Broadcom, Marvell, Lam Research, Analog Devices. I think a number of interesting high quality names to be looking at in this downturn. And as the policy side starts to stabilize, we think these are the names that investors could come back to.
All right. What's up, guys? What's up? It's March 13th, 2025. All right. So let me get to some cycle stuff right now first. Okay. And then I'll read some articles. Let's get to it. All right. There you go. All right. And then I'll put up some music. All right, my little chill vibes. There we go. So here we got oil here. I got my cycle analyzer, and we hit our peak back in, looks like late January. Yeah, late January, early February. And let's see if we can get down to the 50s. I mean, Donald Trump wants it to be $50 a barrel. So let's see if it can get down there. Around May, maybe around May we should look at it. But it could be a bottom right now. I'm not sure. I'm not sure if Donald can get down to that freaking level. I think that's pretty excessive. But if the market really thinks we're going into a recession, it'll definitely dump oil even further. That's possible. Now, the other thing, too, is we have to look at China. If China's demand starts growing, then that could offset it, right? So we could just be going sideways into June. So it could just stick around the 60 area, 60, 65, and not get down to 50. But if it does crash to 50, yes, that will be a great time to buy up a bunch of oil stocks. Okay, but not now, not now. So I'm going to look at the coal prices. Coal prices have crashed in February. So this is the Australian coal price, okay, Newcastle. So we're going to use that as a proxy for the global prices of coal. And coal is a competitor of natural gas and oil, all right, mainly natural gas. So the third world essentially will trade off coal and natural gas. Natural gas is a bit more pricey, it's less pollutive, but if coal starts ramping right back up, then yes, natural gas will follow it. And natural gas so far, for the US at least, has been moving up. And I think Europe will follow suit as well, unless Russia sanctions are released. I don't know if that's going to happen or not anytime soon. So we'll just have to assume that coal prices will start moving up with China, because we are now below. We are below even the invasion time prices, right? We've been doing that since 2023, but now we're just even below the pre-invasion time prices, back to maybe around when COVID was in full swing. So yeah, it's quite depressed right now, coal prices. So when we look at that, we have to see where the bottom is. And when you see the bottom of this coal price with the oil price, the natural gas by itself, yeah, will go up. So let's look at natural gas right now here. So the cycle right now looks pretty good for natural gas because we should hit another low in May. Natural gas has been fighting this top area at $4, 30 to 50 cents per million BTUs, British thermal units. So yeah, I'm looking for a May bottom here. Okay, so let's look. We got maybe a bottom in May to June in oil. We have a bottom, maybe the bottom's already here, but we could have another bottom around late April into May. Okay, and then let's look at gold, another commodity. Right now gold is probably topping. I'm not sure yet, so we could be near a final top of gold. I'm looking for a big push up. So yeah, you have your silver stocks, you have your gold stocks, right? They might try for another push. So we have EXK, that's one, and I'll probably have to look at some others. I will probably add, if I feel like gold is gonna boost up next week, yeah, chase it all the way up to like some, okay, let's say it gets to 3,500. Maybe that's the top. All right, that's the top for gold for this period. Then we start going maybe sideways to down into next June, maybe, because I think there's a bigger cycle into next year. So we might be going up and down into March or April 2026. Because if I show you the weekly cycle, okay, it doesn't look very good. All right, so the longer term cycle shows that gold itself is about to top, but you know, I'm not going to be 100% sure yet. I need more proof here. But it's possible that we could be close to a top either now or in the summer for gold and silver. Maybe that'll be it. That'll be the local top. Then you got to wait for next year for it to climb up again. Okay, it'll take a while. All right, let's see. Oh man, okay, it takes a while to load up. All right, let's see. Okay, so I think this 230 week cycle, let's see. Yeah, this is it. This could be it. So we even, like, you know, if you guys were in gold and silver since the 2022-2023 era, because yeah, that's why I told people to buy a lot of silver and gold. I don't know, not a lot of people listened to me. At that point, it was like, it looks boring. It's going nowhere. And then all of a sudden it just starts shooting up. You know, around like over the summer, I just told my mom to dump all her junk jewelry. Any scrap gold and silver, just dump it in the summer. And probably later on, yeah, I'm gonna dump all the paper gold and silver that I have. This is probably the end. I'll come back in 2026. So you see the bottom here, it's sometime in the summer of 2026 into maybe 2027. So sometime around here will be the bottom, maybe, right? There's no guarantees, but I would say like most of this move is done for gold and silver. It doesn't mean like it's going to go down, right? What will probably happen is it's going to go sideways. It's going to be painful. It'll just be like here. You see 2020 into 2023, like even though you have an up cycle, it was near the end during COVID, and you just go sideways. Very annoying, very boring, going nowhere. And you know, you'd rather just put your money. So if you have a lot of paper gold, paper silver, yeah, you just rather have your money in bonds or something else. At least you get interest. Gold and silver doesn't pay you interest. Or, you know, we also have oil, palladium, platinum, wheat, soybean. There's always something else. There's always something else to put your money in and wait a while and come back there. If you have physical gold and silver, no, you don't need to sell it. Okay? And it's not liquid anyway. There's nothing there to, yeah, EXK is crazy. That's why I said, yeah. So I'll probably add to EXK. That's what I was talking about, like, 2 days ago at night. I was saying, like, damn, EXK is up 20-something% off of those earnings. Silver is, miners are starting to go back up. Gold is starting to go back up. I just need to wait for Powell and Ueda from Japan. So Japan, Ueda, central bank, Powell, central bank. Those two guys, they talk next week, Tuesday night, and then Wednesday afternoon, back to back. and then that will determine where gold and silver are going to go for the next month or so, right? Next 2 months, maybe next 2 months. And if it does, good, I'll just catch it. But you have to be aware when this is a commodity. Every time you have a commodity, you shoot up. The last move up is a violent move up, and then you crash. That's how commodities work. Commodities never have a slow top. You know, it takes, like, you look at the S&P 500. It took 3 months for us to crash like we are doing now. But commodities never do that. They just shoot up, and then they go bye-bye. We reach the highest point we can, and we go down. We go back down. That's the problem. All right, let me look at eggs. Yeah, look at eggs. Look at these commodities. They shoot up, and they crash right away. So eggs now are $4.89 a dozen. They were at $8.16 a dozen. So that's how commodities roll. They roll like this. They don't let you sell, you know. If you start flying up, you better get ready to have the escape hatch like ready to go, you know. You got to jump out the damn plane. It's like, I'm not going to stay here in the plane when it crashes. So yeah, eggs going down. All right. Coal going down. All right. And what else? Okay, we're going to talk about this later. Consumer inflation expectations and all this stuff. Okay. Let me go back to the semiconductors now, since that's in your mind after you watch that. TSMC pitched Intel Foundry joint venture to NVIDIA, AMD, and Broadcom, sources say. Okay, what does that mean? So TSMC, their competitor, AMD, Broadcom, NVIDIA, all competitors, about taking stakes in a joint venture that would operate Intel's factories, according to 4 sources familiar with the matter. This was written yesterday, March 12, 2025. Under the proposal, the Taiwanese chip-making giant would run the operations of Intel's foundry division, which makes chips adapted for the needs of customers. But it would not own more than 50%, the sources say. Qualcomm has also been pitched by TSMC, according to one of the sources and a separate source. Okay, I don't know. That sentence sounds weird. The talks, which are at an early stage, come after U.S. President Donald Trump's administration requested TSMC, the world's leading contract chip maker, assist in turning around the troubled U.S. industrial icon, the sources said, on condition of anonymity because the talks are not public. The details of the plan for TSMC to take no more than 50% stake and its overtures to potential partners are being reported for the first time. Interesting. And then we get a new CEO the next day. What does that tell you? So, yeah, they need a lot of help from China. Any final deal, the value of which is unclear, would need approval from the Trump administration, which does not want Intel or its foundry division to be fully foreign owned, the sources said. Intel, TSMC, NVIDIA, AMD, and Qualcomm declined to comment. The White House and Broadcom did not respond to requests for comment. So, yeah, I think so right now, new CEO of Intel, Chinese Malaysian, TSMC, Taiwanese, NVIDIA, Chinese Taiwanese American, AMD, Taiwanese American, Qualcomm, I think it's still white, I don't know, Broadcom, Singapore, Chinese. So I think all these major semiconductors are pretty much Chinese owned. Interesting. At stake is the future of the U.S. chip-making giant, whose shares have lost more than half of their value in the last year. Okay. Intel reported a 2024 net loss of $18.8 billion, its first since 1986. God damn, since 1986. That's pretty much when they started having stocks of Intel. Driven by large impairments, the foundry division's property and plant equipment had a book value of $108 billion as of December 31st. According to a company filing, Intel stock rose 6% in early U.S. trading on Wednesday, and, well, it was up maybe over 11, 13%, something today on the CEO news. Okay, very interesting. Now, what did I tell you guys to look at on Monday night during that drop? I think I said Monday afternoon, and then I came on Tuesday night, and I said, like, look at SOXL, 3X semiconductors, because they were beating up those semiconductor stocks right into Tuesday even, saying like, oh, well, Trump's going to repeal the CHIPS Act or something like that, this and that. And the next 2 days, they pump it back up, saying like, oh, look at that, TSMC, Intel, blah, blah, blah. And now they got a new CEO for Intel. Great. See, these guys, they selectively choose when to release news. And it's always timed around the most volatile periods. So we are at the most volatile time. So one day you're up, next day you're down. One day you're up, next day you're down. And didn't I say, like, you have to do day trading at this point? Because, yeah. But right now, this week, I haven't been doing any day trading. I've been chilling. Just, like, I bought my stuff at the lows on Monday. I'm just waiting. I'm just waiting for the turn. I want to see where the turn is. And I was hoping that the CPI could do it. Okay? I was hoping that the CPI could do it. So let me get the chart up here. And then I'll read you another article. Like, pull that back up. Tropes, yes, that was because of the yen carry trade. So the difference now is that the earnings suck. That's the difference. So that was just a scare because the dollar started so if you have to know about the yen carry trade, it's basically, if you also watch Samantha LeDuc's videos on it, like, she's always talking about it. And during that time over the summer, at that point, the Japan started raising their rates. Okay, and let me see if I can find that old chart where I just drew a big fat arrow to what was happening, and it was on those late night streams. Well, not late night, but it was on the 24-hour stream. I don't know if I was talking about it. So I kept talking about yen carry trade. So let me see if I can find it. Oh man, where is it? Where's that crap? Okay, here it is. All right, let me get this away. I'll stop this screen and put another screen. And we even have it. We might have a second yen carry trade because Samantha was like, "Uh-oh, it might happen again." So that's why it's like, yeah, we'll probably go up for a couple weeks, and then the yen carry trade will reappear and crash the market even more. So this is what happened. So right here, you see July. You see this? This is the yen over the US dollar. So by July 1st, it was 160 yen to get a buck. All right? And then all of a sudden it started crashing. Crash here into August. And guess what? What happened at that same time? Stock market crashed. Because all the rich boys had Japanese bonds. They had to offload. Okay, they were in Japanese bonds, using that to fund Mexican bonds, using it to fund Brazilian bonds, using it to fund U.S. treasuries. That's a carry trade. Like, you're basically buying bonds in another country with a different exchange rate because you got yen versus dollar versus Mexico pesos versus Brazilian real. And then you're using the difference between all their interest rates, all their FX to make money. Because you're just using one place to get a cheap loan to get more interest in a place with a higher interest rate, like Mexico, Brazil, or the US. That was what was happening. And what happened was Bank of Japan raises rates 2 times, first time since 2007. And you can go to that article, archive.is/3UYGK. And then at around the same time, we had other news from Powell around that same moment, and then that whole thing started crashing. So that was it. That was why. Why is this time different? Because this time the earnings sucked. It's not good enough to support the expensive PE ratios. The valuations, Shkreli, if you go to Shkreli's, that's what he's always arguing about. Everything is overpriced. Everything is overpriced. Everything is overpriced. He's going to yell and scream and argue that everything is overpriced. It doesn't matter if it's overpriced. If people have money to pay for overpriced stuff, they will do it, right? So if I have something that's worth more and it keeps getting worth more and people want to buy it because it's just because its prices keeps going up, that's called a Veblen item. In economics, that's what it's called, a Veblen item. So luxury items act that way, right? When do you see people buy something that's more expensive? So there's more demand coming in when something gets even more expensive. That's like stock market. So when they see Nvidia going up, they'll just keep buying it because that's just the behavior. It's just like somebody has a Gucci bag. They don't want to buy a Gucci bag if it's $2, but if the Gucci bag is $10,000, they'll be like, oh damn, why is that damn bag $10,000? I should buy it. Because someone else thinks it's $10,000, I should buy it, right? For $10,000. That's dumb. That makes no damn sense. That goes against any economic rule possible. So, yeah, buy high, sell higher. So they keep going into that mentality. They think Nvidia keeps going to go up, and that's what happens. When Nvidia stops going up, guess what? And that July point was the last time Nvidia was that high, remember? That was the time I told HB, sell Nvidia, buy Palantir. Anybody who kept holding Nvidia that time, like, couldn't sell at a higher price during that time, because like if you look at Nvidia, did Nvidia go anywhere since that point? Let's see. Yeah, June, July. Yeah. So if you sold it at 130, how much higher could you get? 145, maybe 150 if you're lucky. You got that intraday high here, intraday high there, but for the most part you would have sold at 135-ish, maybe 140, and got out at 145. It didn't go nowhere. It didn't go nowhere for freaking months on end. This was half a year basically. And look at Palantir. So that same point in July, you would have went from $20 to $126. So sucks to be someone holding Nvidia for all that time when they could have went somewhere else. Your money is in competition with other things. That's why prices go up and down, because it's not just one stock, right? It's not just one commodity. It's not one bond. There's multiple bonds across the world. And not only government bonds, but also corporate bonds. I could buy like an Apple bond or like a General Motors bond, or Ford bond, or a Delta Airlines bond, and that's different from something somewhere else, another corporate bond like a Novo Nordisk with like their Ozempic. Maybe those bonds are more attractive. So rich people have a big playing field. They have lots of people looking out to where to park their money. People didn't want to play around with Nvidia anymore. The only people who talk about Nvidia from that point on were people in CNBC, because they just want to keep pumping it. Because probably all the rich guys were slowly selling out at the highs here. They can't sell all at once. They got to sell piece by piece, right? They need volatility, and you can see it's shrinking. Like the volume is shrinking, so they're gonna be like, well, I can sell some shares here today, and I'll sell some shares the next month, and I'll sell some shares the next month. And they probably were selling all throughout here, from $135 to $150, anywhere they could. And then once they were done, guess what? All the retail guys got suckered in to buy this year here, and that was the last thing. That was the last exit point. And now this thing is going to go all the way back down, probably. But it won't go straight down. It'll fight. It'll go here. It'll bounce. It'll go. It's great for trading. If you're a trader, you can trade up, down, Nvidia all day long until it finally collapses. And so it's probably going to happen in 2026. So we got another year. We got another year of this game. So that's why I told you guys to buy Nvidia, buy Tesla, because guess what? This thing will probably rocket back up. You can trade it up, then you can trade it back down, trade it up, trade it back down. And yeah, because when it broke this area, I had a target for Tesla. Tesla was, I think I could see it being at 700 something based on a point and figure, because this whole area could be a big accumulation area, right? It could be like this. A lot of people bought here at 120. They bought again here at 138. It kept rising. It got to 400. It's like, if it could hang around here, yeah, it could still go to 700. I could see that. I could see that go flying into New Year's or something. Maybe this thing will just goof around here 700, but then it'll just crash right back and go back down to 150. And then in 2020, like later in 2026, maybe the second half of 2026, it keeps fighting here and then it'll just collapse. It's never a smooth line. So these are great opportunities for trading. For investing, it might be, yeah, you're not going to get anywhere. So this, if I looked at this, I would say like, yeah, it still could be accumulation. I don't know yet if it fights here. But if it just goes back down and just keeps staying down here for the rest of the year, then it's over. You're done. If you cannot even get back to 280 in any significant fashion, yeah, you're finished. You're toast. You're toast. You're better off in China. So that's why I was like talking about Chinese stocks over the summer, because I said like, this is the competitor of Tesla. So Tesla was going sideways. This guy was going sideways. BYD is the largest electric vehicle car manufacturer in China. Most of Tesla's growth is from car manufacturing. The only reason you wouldn't do this is that you believe in the AI story of Tesla more than the electric vehicle story at this point. And since Elon is going around the world and talking a lot of politics, that is hurting the brand of Tesla, right? So that also is a problem. Whether or not that's a bigger issue or not, I don't know. But as you can see, BYD is holding up here above 80. If it keeps holding up here, then it's going to fly higher, because we haven't been here ever. If I do the point and figure chart analysis of this rectangle, I could probably figure out how high this could probably go. So yeah, I wouldn't buy this thing now, but I definitely will be looking at it later this year to see if I can get in. How low do you think Nvidia will go? All my shares are under 80, about half of those. Okay, I don't know right now. It's too volatile to tell now. I do think semiconductors are probably topping out. It doesn't mean Nvidia can't get back to 150, but yeah, I think oh man, I mean, based on the weekly chart, I think you're done. Yeah, you're probably not gonna get anything above 130. Like you're gonna just get something at 130 for a brief moment of time, and it's just gonna go back down. Yeah, that's it. We're done here. There's better things to put your money in: oil and gasoline stocks, natural gas stocks. Those will be the next ones moving up. Yeah. So I don't know why you would bother staying here since June and July. I told people like I don't like this stock anymore. I mean, what's the point of this? I mean, if you wanted a tech stock, it was Palantir. Palantir was the AI baby. Software is going to be the new AI baby, right? Palantir was the first one to get out of the gate. The problem is right now, like if you look at Asan, like look at this. Like shoot, man, now we're back down to 11. Like if this thing could have held like 16 and stayed closer to 25, yeah, this would have been great. So a lot of software companies like this, Twilio, like they use AI. Their AI use. See, you hit this, you see that? Like this was like July 2019. You hit right there and you go right back down. Like crap. Software AI is where your money should be in. Palantir was just the first one to like escape and get out of this base, because Palantir just has a lot of hype, and it also has a lot of political influence. So that's why Palantir can escape these issues. But if you look at other things like Twilio, Asan, like man, I would have loved to see this thing continue, because I would have put all my money on software AI, not hardware AI. The other thing was like the nuclear stocks, right? Constellation. This thing could have been something great, but now it's like already breaking down too. So utility stocks that have something to do with AI. Yeah. How low it could get, who knows? I can't predict that. I don't have any crystal balls here for that. I just look at the chart and go like, I don't know how high it can go anymore, because once this thing completes, then we could do a point and figure and say like, okay, this is a done deal. This is distribution. Then you do a point and figure analysis, and then you can derive how low we can go. That's how you would do it. So I can play a video with the point and figure stuff. So if you do the point and figure, yeah. So here's an example. So I did a bunch of point and figure things before. So here's one for the S&P 500.
This is the chart we just showed you from February 25th on the left. And all I wanted to do was just take the same counts, and the yellow one is the conservative count from the highs. And you can see that it takes us down to 55.50. The green count is just taking the midpoint of the range. So when you do that, you just take the average of the middle of it. And that takes us to 53.75. And here we are. We're right into the minimum of the objective range. Could work lower.
There you go. So based on this point and figure chart, the S&P 500 has hit 5,550, and the lowest point is 5,375. You can do the same thing on Nvidia and Tesla and all that. So once I know that those things are actually distribution, then yeah, I could give you an estimate. Doesn't mean it'll go there. But if you want to know how low it can go, yeah, based on the chart, like with the point and figure, yes, you can derive it that way. That is one way to derive it. Point and figure. Okay, so back there, let's see. SPX. Yeah, you won't know. You won't know tropes until the game is over. The only thing you can know is that something's fishy. When it does something like this, and you start seeing weakness build in, then you wouldn't be surprised. Once you complete the move, this is two weeks of big red candles here, right? Larger than anything that's come before. You had 3 medium-sized reds, 1, 2, and then 1 large, but then a recovery. And this one, you're below the weekly 40-week moving average. That's it. You're done. That's it. You don't know what's going to happen now after. It could just go sideways, right, from here, and then keep on going until 2026 and then go up before falling back down, or it could just decide to just keep going down like in 2022. Yeah, you don't know. You won't know. You just have to take it day by day. The only thing you can know is that, like, yeah, I wouldn't have been like fully bullish this year because, as I said, Jerome Powell, in December 16th, when he opened his mouth, it killed the market already because you saw the small caps dying, right? You saw the small caps dying. Small caps completely died. This thing was already looking bad. When the small caps go down and then the large caps go down, then who's left to hold up the market? Nobody. So the small caps are the little boats. The little boats will tell you what's going on. And then the big boats, when they start following, that's it. And since we're going to talk about the big boats, let's look at the big boats. There's actually 7 big boats here. You got Google, Apple, Microsoft, Amazon, Nvidia, Tesla, Meta. And what does this thing say? What does this chart say? So when I take out the S&P 7, so this is just the S&P 7. Okay, this is S&P 7, just this chart. I'm not doing the S&P 500. I'm doing S&P 7. This is 20% already. 20% is a big correction. 20% of the 7 stocks that control 35% of the S&P 500 in market cap. So if the small caps aren't going up, and these 7 big caps aren't going up, then how is the market supposed to go up? They're not going to go up. Oh, Tom Lee. Tom Lee's an idiot. He always says bullish things. Okay. This is a problem. People on CNBC just always says the same thing. They don't tell you when to get in and when to get out. So Tom Lee says the same thing down here, up here, in the between. They can't tell you when to get out. They just tell you buy, 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 buy. That's all they're paid to do. That's all they're paid to do. They're just paid to do that because they need you guys to give liquidity. The only reason a rich man can sell billions of shares in a day, within a week or a month, is because a lot of little fish got to keep the ocean currents moving. That's why they need retail. They need retail. Retail are there to give liquidity. So if I went to real estate, what's the liquidity in real estate? There's no liquidity in real estate. A guy decides to sell or buy a house when it's available. They don't buy and sell houses every nanosecond, right? So in the stock market, it's different. You need a market maker. What the market maker does is they give fake bid and ask prices. So they'll just make a fake bid or ask out there and say like, okay, and then you guys are filling in the potholes and then you make the liquidity in between those moments. And that's what happens. So they always have to get on CNBC and say those things because they need you guys to buy or sell when things are at their highest and lowest points. Okay, they got to generate liquidity. That's his job. Oh yeah, he was swearing by I heard him. He loves small caps. And it's like, bro, I would love small caps too if it didn't do this. Like, this was even before Jerome Powell talked, right? It got up, it broke out. This thing was a long-term resistance since COVID. So this was the whole era of COVID. Low interest rates, right? 0% interest. Go up, 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 up. You hit a wall. Go sideways. And then Jerome Powell said like, oh, wait, I think inflation is not transitory. And then the whole thing starts going down. And then like they had Omicron and all that crap. All the news came at once and it went down here. And we've been going sideways up until 2023. We've gone up right back to where we were in 2021. And that same moment, that same peak right here, 243 on IWM, you slammed your head right there and you start crashing right away. You think I'm going to be bullish? Nah, I'm not going to be bullish. That was already a signal to me that the next year was going to be not fun. It was just going to be traders. Like, it was just all about trading. Because once I saw this, it was over. I already knew then. And then once I heard like Tom Bowley last month started being bearish, all these guys, once they start going bearish, oh shoot, that's it. We're really going to have a headache. And it's just confirmed everything I was thinking. Yeah, that's it. Now we're back here, 198. Oh, good job. I mean, if this thing breaks down to 170, yeah, you're done. You're toast. Especially when bond prices are moving up, so yields are going down and IWM is going down with it. Yeah, that's not a good sign. Not a good sign at all. Okay, anyway. So yeah, you're at 20% here. So if you talked about the Mag 7 by itself, you're at 20%. But yeah, we got time. We got time to go back up. I'm sure of it. So let's say let's get something here. Let's say zip, zip. Yeah, we could do this. Okay. A, B, C. Everything goes like this. It's a wave. So everything in the stock market goes like that. A, B, C. That's what they call ABC. It's ABC wave. Okay. So here you go. I could draw it like this. A, B, C. Right there. So yeah, that's how you draw it. ABCs. Everything's in a wave. Everything has a wave. Nothing goes down straight. So I would say go back up here, probably at this level, probably at 33, based 33% on my little chart here. Yeah, of the S&P 7, and then we'll go back down. How about that? All right. And the funny thing is, like, there's always this Dan Ives guy on CNBC too. This guy's always yapping. I wasn't gonna play this video, but I'll play a little bit of it. Here, you can read this guy. This guy's always on CNBC pumping Apple and Tesla.
50% drawdown from its recent high. Several negative notes this week about that stock, not from our next guest, though, who has defended it and more than once. Dan Ives is Wedbush Securities Head of Technology Research. He's here with us at Post 9. Thank you for coming on
great
today.
to be here.
I appreciate you being here because I think it's interesting that you have defended this name not once, but twice in the last handful of days. On March 6th last week, you called it a table pounder. Last night, you said your bullish view was unchanged. There are a lot of questions about the stock. It's been down 7 straight weeks. Why'd you feel compelled to come out and defend it not once, but twice?
Yeah, I mean, well, first, I mean, we've been talking to investors, all around the world on Tesla, and it's like, is this a moment that basically the bull thesis basically gets thrown out because of some of the brand issues, the distractions? And our view is when things are great, okay, anyone could be there. But when things are tough, moments like this, I think that's where we've been able to guide Tesla investors over the decade, right, in terms of these moments. I don't believe that this is really a black swan event for Tesla in terms of the brand issues, in terms of something that could really deteriorate the medium and long-term outlook. But no doubt, we've talked about it. It's a moment of truth for Musk. No one, including ourselves, expected he'd be this involved in Doge, this involved in Trump administration, and it's really cascaded, and I think this is a pivotal moment for him.
Explain to me how you go from your bullish view unchanged, those are your words, last night, to this morning where you put out a note ahead of our appearance where you call it a moment of truth. What happened from last night to this morning where you didn't have that perspective until this morning?
Yeah, that should tell you something. If he's not dressing as flashy as he can, that probably signals to the people that it's going to get worse. It's just like, oh, listen to how many times Jerome Powell like coughs into the mic, or how many times he like touches his tie or some BS like that. Yeah. It's a hidden signal. Yeah.
Yeah.
How does this happen?
I think from our perspective, it's more hearing Musk, hearing from investors around the world, and it's basically us saying the medium long-term case for Tesla, I continue to view $2 trillion. I believe when it comes to physical AI, autonomous robotics, they're actually the best position company in the world. But with that said, to hear Musk continue to talk, and again on social media as well, it's really us trying to explain, like, look, this is the time, very similar as we saw during Twitter, very similar as we saw even called a year and a half ago. This is the time to lead. It's a time to be CEO, because I think patience is wearing thin among investors, and it was really to communicate those thoughts at, I think, a pivotal time for the stock.
The reason why the stock is down seems to be a confluence of events. Obviously, his presence within the administration, as close as he has become, he's become a much more polarizing figure.
All right. Whatever. I don't need all that. Like, let's look at the Tesla chart. I already went over this. I drew this thing too in February, right? I said, like, I think it's gonna go up and then go back down here to 183. Now, I didn't know it was gonna go all the way down to 222, but all right. But if you can see this, look at this one. In December, you can see the big blow off top right here. Now, this point around December 18th, right? That point here was Jerome Powell. So he took it down. Of course, it's not as badly as the small caps, but it was damaging, because ever since this candle, you see every candle here in December couldn't get back to that high. You definitely never got back to 478. Now, since then, in the new year, you see how Tesla's doing. It's struggling, going below this 402 price. This 402 price is very important, because this was the last high in November of 2021, just like those small caps, right? November 2021 was the last high. Now you keep fighting around it. Fight. And guess what? We had earnings January 29th. And at that moment, you see the day after, you couldn't get anywhere. You had 2 days where you were stuck at that 405 area. And then the week after, you start moving down. You hit here, 333, you go up. But my guess was once you go up, you're going a lot lower. And that's what happened into February, into March. That's it. So just by basis of this chart, from its failure to hold that 405 level after earnings, that was enough. Okay. And we have to really look at the earnings of those magnificent 7 stocks. Yeah. If Jensen, well, yeah, you're going to be, well, I mean, Alex already hates the left. That's why he left like Silicon Valley. He moved his headquarters to Colorado. He's always been hating the left, but he's actually just more pro-Israel, right? So that's pretty much it. But Jensen, yeah, he's not going to do any politics. It doesn't matter, really. Elon, like, it's just like is a whole nother separate game. Most CEOs don't talk as much as Elon does. Alex gets pretty close to talking a big game. He also has his book out and all this stuff, so he likes to talk too, but not as much as Elon. Yeah. So anyway, but it's all about the earnings. So I'm gonna play this one. You can look at it and discuss about the valuations right now.
Uncertainties remain on tariffs, the economy, the Fed's path. Well, joining me now is Niles Investment Management founder Dan Niles. Dan, welcome. So the real impact of tariffs, you say, is going to be seen in future months. So this benign inflation read maybe doesn't mean much?
Yeah, it really doesn't mean anything, John. I mean, this reading is for prior months. Obviously, this tariff uncertainty started to kick in mid-February. And so we're going to have to see how much of that feeds through into CPI and PCE in coming months. The one positive is, don't forget, oil prices, which go into pretty much all goods, whether it's through transporting them or making them, they've come down from about $80 in mid-January into the mid-60s. So that's a big positive. And 10-year treasuries have come down from 4.8 to 4.3. And so that helps as well. And then let's not forget the dollar, down from about 110 to, let's say, 104. And that's also helpful. So the funny thing is, a lot of the things that I was worried about coming into this year, those have retreated, which is great. But that's why I was negative coming into the year and had cash as one of my top 5 picks entering the year. And none of the Magnificent 7 is a top 5 pick either. So there's puts and takes on both sides.
Now, I think in recent days you've been saying that with stocks dropping, you might have to hold your nose and buy some of those tech names that you were, I guess, rightfully bad-mouthing as being overvalued not too long ago. Did the tariff turbulence over the last couple of days stop you from picking those names up, or are you doing it?
No, I did it, and I did some more today. And let's be clear. It's not the tariffs knocking these tech stocks down. It is the fact that revenue estimates for 6 out of the 7 biggest in the Mag 7 all went down for Q1 after reporting Q4. So there's this common misperception that, oh my God, it's tariffs hurting these stocks. That's not it. It's earnings hurting these stocks. And that's why the Magnificent 7 are down 13% year to date. But if you look overseas at KWEB, which is the China Internet ETF, that's up 22% year to date. And even if you look at some of the people we're having tariff, spats with, Mexico. That, if you look at EWW, which is the Mexico ETF.
Hey, didn't I talk about EWW? Didn't I talk about China?
That's up 9% year to date. The Europe ETF up 15%. So
I hear what you're saying, Dan, but let me, I know you argue the tariffs themselves aren't doing it, but isn't it kind of like turning up the lights at the party? I mean, sure, the music hasn't stopped, but when the lights come on, you know, it feels a little less fun. The tariffs, do they make the markets for retail investors and maybe some of those that were leaning into risk, does it make it feel a little less fun?
Well, it should, because you shouldn't be investing just based on the fact that stock prices are going up. And that means you're going to have an unhealthy market. So this kind of uncertainty where people have to actually sit down and go, well, should I be buying Tesla when they had deliveries down for the first time in over a decade? Maybe I shouldn't. And so I think that, though, goes through to all tech stocks. And I think this year, you're going to get out of talking about the Magnificent Seven as a group and start to talk about them as individual companies, because each one of them has very different drivers. And even today you saw that with some of the names down and others up, most of them up actually. But so you're going to start to see some differentiation, which I think is good. And you're also having people finally starting to talk maybe about valuations and what risk are you taking buying different names when some are not growing, trading at 30 multiples, and others are that are trading in the low 20s. And so all of those things got to come into play. And so to some, you're 100% right. Does it make it tougher if all you're doing is looking at a stock chart? Absolutely. But I think when you start to focus in on fundamentals, it actually makes it a lot better, because then risk and reward are both getting worked into the equation versus just, well, the chart looks good, so I'm going to buy it.
Oh.
All right. So let's look at. Let me reintroduce you to some economics here about a Veblen good. Okay, Veblen good. What is a Veblen good? Veblen good is a type of luxury good named after American economist Thorstein Veblen, for which the demand increases as the price increases, in apparent contradiction of the law of demand, resulting in an upward sloping demand curve. The higher prices of Veblen goods may make them desirable as a status symbol in the practices of conspicuous consumption and conspicuous leisure. A product may be a Veblen good because it is a positional good, something few others can own. Well, I don't know if people are like chasing Nvidia because it's a Gucci bag, but it has that same kind of behavior, right? That psychological effect. When every time these people just go on CNBC and says, well, there's only 7 good stocks you should buy. You should buy them. And the funny thing is, this week, it's had quite a bad week for Apple. Apple is the darling of stocks that keep getting beat up. I mean, they just always beat up on Apple. It's amazing. So right now, Apple is down 3.36% today. I don't know why, but for the whole week, it's down 12.29. Like, holy crap. When was the last time you seen Apple do that? Like, let's see. What was the last time? 2018? Like, that should scare the shit out of you. Apple is like the golden goose that is always stable. When was the last time it did that? 7% here. Nah, man. I think it's going to be hard pressed for me to find a 10% down week for Apple. Of course, we still have Friday tomorrow. Maybe Apple will recover, but let's say it stays that way. 2018, yeah, pretty close. 2018, during the crazy end of year Q4 of 2018. Yeah, okay. How about here? 12% in the COVID days. That 1 week we had a down 12%, and a second one down 17%. So COVID. So 2018 and COVID, that's not a good sign. If you're as volatile as COVID or 2018, well, Jerome Powell better save the stock market next week, or bye-bye. Bye-bye. You don't want something like Apple to be this volatile. That is a bad sign. Terrible. I think they keep getting reports that, they can't sell enough iWatches or iPhones. Apple doesn't barely innovate. But the problem is, all-seeing guy, Apple has a lot of suppliers. They source their suppliers from throughout the semiconductor industry. When Apple sneezes, then everyone else is going to sneeze. You're going to see Skyworks sneeze. You're going to see Qualcomm sneeze. Then you're going to see the Lam Research sneeze. That's the problem. Apple's a big company. So that's why the Mag 7 go up as they do, because they basically influence a lot of other companies' results, right? Like SMCI is dependent on NVIDIA. If NVIDIA says something bad, SMCI goes down. SMCI jumped up just because of NVIDIA. It goes down because of NVIDIA. That's the reason. So, and when you talk about Apple, you're multiplying by multiple shares of multiple stocks. It goes up 400% because of NVIDIA. It goes down 400% because of NVIDIA. Yeah. So that's the problem. That's why you don't want Apple to be doing what it's doing, because it signals that the broader economy is going to go down. That's the problem. Because as you know, we are a service economy. So if people don't buy Apple junk and get stuck on the iCloud, that says something. That does say something. Okay. Now, let me go back to the articles here. We have to talk about the eggs again. So we look at eggs here. Eggs are very important because let's look at this article here. U.S. producer prices stall while details suggest firmer Fed gauge. Today we had the PPI. Yesterday we had the CPI. Yesterday CPI had a good reaction in the morning. We were up 1.7% pre-market on the Nasdaq, I believe. But that all got faded down, and then today the PPI didn't, and we had to fade down again. So let's read what this says. U.S. wholesale inflation stagnated in February thanks to a sharp decline in trade margins. The one measure of good prices jumped, and details were also less favorable for the Federal Reserve's preferred inflation gauge. That's the PCE. The producer price index was unchanged from a month earlier, following a revised 0.6% increase in January, according to a Bureau of Labor Statistics report released Thursday. Excluding food and energy, the PPI declined for the first time since July. Okay, so that should be good news, right? The index was weighed down by a 1% drop in trade services, a category which reflects changes in margins received by wholesalers and retailers, categories that inform the Fed's preferred inflation measure, the Personal Consumption Expenditures Price Index, PCE, were largely firmer, including a 1% increase in hospital inpatient care. Oh, crap. It's always healthcare. And a 0.5% rise in portfolio management costs. Oh, great. So some people's 401k fees just went up. Goods prices, excluding food and energy, also advanced by 0.4%, the most in more than 2 years. A drop in margins tentatively signals that consumers will be shielded from some of the forthcoming increases in manufacturers' selling prices and import prices. Samuel Tomes, the chief U.S. economist at Pantheon Macroeconomics, said in a note, with consumers' confidence weak and many people already having brought forward purchase of durable goods, demand for goods will be very weak later this year, forcing retailers to accept thinner margins. Thursday's data followed a BLS report Wednesday, which showed consumer prices rose just 0.2% last month, the smallest increase since October. However, details from the CPI also pointed to a higher PCE price gauge when that figure is reported later this month, and economists are already looking ahead to a potential impact on prices this year of sweeping tariffs imposed by President Donald Trump on the country's largest trading partners. Okay, so let's look at this. The PPI data also showed food prices rose 1.7%, the most in 3 months, amid an ongoing surge in egg prices. Energy costs declined 1.2%. Well, egg prices are moving down. So I think the next several prints of egg prices should help that part at least. But honestly, I don't know. And also lower gas prices. See, let's look at gasoline here. unless you live in the West Coast like me, yeah, gas prices have been low since September. But yeah, most people on California side will not see any benefit from gas prices going down. As far as crude oil prices, let's see if that trickles down to the gas prices. We are at $66.90 something cents per barrel, right? And I know some of you guys complain about natural gas. You got heating oil going down. So diesel prices are going down to $2.16. Natural gas, however, is going up. It's the only commodity that's pretty sticky right now, huh? All right. So yes, we'll have to see. We'll have to see how that goes. And Petco, imagine that. Yeah, Petco. Lululemon. Yes. Yes, white chick stocks. Yeah, I think Lululemon isn't doing good. I don't think so. Last I checked. And you should check Ulta. Ulta, yeah, makeup. Yeah, Lululemon's back down in the range. Ulta should still be down. Yep, Ulta's making a new low today from its past 52 weeks. So new 52-week low for Ulta is down 4.48%. So yes, that is down. Definitely. White chicks are not buying shit. Okay, so you simps better keep paying, or else the economy is gonna go down. That's why the S&P is going down, because you simps just are not paying enough. Please pay more. Anyway, I don't care. I'll just keep shorting or whatever. All right, guys. I think that's it for those two articles. Let me do a summary here. Producer price index. All right. Let me do this. Let me refresh these two. So I'll do the producer price index. Let's do consumer inflation first. CPI. U.S. consumer inflation expectations. Oh, okay. That's tomorrow. My bad. Yeah, I don't care about that right now. All right, that's tomorrow. Let's see. Blah 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 blah. This week. Yeah, there's Michigan consumer expectation data will come out tomorrow at 10 a.m. Eastern. I don't know what that's going to do though. If that's going to reverse anything, it could just be terrible. And Friday we'll just have another crash. If we do have a crash on Friday, then I would have to say come back on Monday. Definitely don't play the weekend, because we have budget. Okay, we have the Congress doing their budget debates, and like yesterday they said like the Democrats might give up on fighting the budget in the Senate because they passed the House. The GOP just steamrolled in the House and they passed the budget there, but then the Senate, they need some, like they have to get 60 votes, right? So they still need some Democrats to join in to vote. So at first they said maybe the Democrats would just fold like yesterday, and then today now they're saying like no, they want to fight. So whatever, you know how it is. The news is just going to make the market go up and down as much as they can. So be aware of the weekend. So if Washington D.C. can't get a budget together by Friday close, expect the news to go up and down all into Monday. Okay, who knows? They'll try to keep the volatility as high as possible into Monday, and you rather just wait it out until Monday. Okay, core consumer prices in the United States, which exclude items linked to food and energy, rose by 0.2% from the previous month in February 2025, from a 10-month high of 0.4% in the previous month, below market expectations of 0.3%. That sounds good, right? Okay. Prices fell for transportation services, negative 0.8% versus 1.8% in January. So your Uber prices should have went down, and rose at a slower pace for shelter. Well, your rent still went up 0.3%. Used cars and trucks 0.9%. And medical care commodities 0.3%. So your boner pills have went up 0.3%. From the previous year, core consumer prices rose by 3.1%, the least since 2021. Oh yeah, great, good job. But that didn't help much, I guess, right? Because let's see, look what the producer price inflation is. Producer prices in the U.S. were unchanged in February from January 2025, following an upwardly revised 0.6% rise in the previous period, and below forecasts of a 0.3% gain. Well, that sucks. So January, they made it go higher. It is the lowest rate in 7 months, with services prices falling 0.2%, the largest decline since July 2024, led by a 1.4% fall in margins for machinery and vehicle wholesaling. All right. Prices were also lower for food and alcohol retailing, automobiles retailing, apparel, footwear and accessories, chemicals wholesaling, and residential real estate loans. On the other hand, prices of goods increased 0.3%. Oh, that's the bad news. The fifth consecutive rise, with 2/3 of the increase. Oh man, come on. 2/3 of the increase attributable to prices of chicken eggs, which jumped 53.6%. But as we can see, chicken eggs are going to go down shortly. Prices of pork, fresh and dry vegetables, electric power, tobacco products, and carbon steel scrap also moved higher year on year. Producer prices rose 3.2%, below an upwardly revised 3.7% in January, and forecast of 3.3%. Oh, this upwardly revised stuff really is bad. All right. So let's see what happens. All right, good. I think we're done with that. Let's go on. Old limit order buys of Ulta kept popping up in my portfolio, and I kept selling them for small gains. Oh, shoot. How old were they? Like, holy crap, you kept like a whole bunch of old ones. Yeah, it's better off you got to try to find a place to short that thing at this point. All right, let's see what other videos I got here to play. Oh, gold. Yeah, let's do gold. Let's do this one.
We get some selling, okay, a little bit of reaction, but we hold, we come down. We know that's hidden buying. And look, we get ease of movement now on these two bars. So this is kind of like a little mini shakeout, this little thing, isn't it?
For those of you, and I heard this from some of the students, well, what about those volume spikes? Aren't those supply volume spikes? They are supply volume spikes. But you have to think in terms of like, okay, relative to the rally that we've just had, those volume spikes produce what? And then, okay, your largest reaction here is probably like 15% retracement. This is nothing. And as William has stated, no follow through to the downside.
I feel as if we're going to tap the highs here, Roman.
So I think, I think we're gonna have a good time on gold. So let's see what happens. Let's see what happens next week. Now let's look back at Ulta here. Yeah, you see Ulta here. So the last high in May of 2017, we just hit it today. We just tapped that today. And once that breaks, goodbye. We're going back to like the COVID days, huh? I don't know where the next one will be. Probably like $200. So maybe if you think this is a big topping structure, yeah, maybe you should find a place to short it. You'll be like, yeah, let me see if it can get back up to 356 or something. Maybe 400, and I'll short it here. And then it'll go down. It'll go down to 200 from there in one swoop. Maybe that's what you'll do. But like I said, I don't know. AOI is the one I would short. So, like, if you're looking for a thing to short, look at small caps and look for the weakest ones. This is definitely the weakest one. So, yep, this was perfect. I don't know if Antoine was looking at I don't know what the option prices are on here. If it's cheap enough, yeah, keep shorting it until it gets to $7. And if you're really lucky, who knows? Maybe the market will shake out so badly this month that it'll briefly get below $7 and get down to $4. And I'll probably go long here and then go back up to $8, and then I'll sell again. You know, that's how you do it. When a volatile market is like this, yeah. So Core is the larger cap competitor, right? This is a more mature stock in the same industry as AOI. It's going to go down to 51, yeah, again. And you might want to buy that there. I don't know yet, but as you can see, like, yeah, you just goof around this whole time, and then all of a sudden you just go back into the range. That's it. Yeah, So a lot of stocks are looking like this, like ASTS. I was talking about on the weekend. I said like, well, you know, if this thing can move up, sure. But looking at this week, down 21% this week. I don't know. It still has a chance. It hasn't broken down all the way to $20 yet, but yeah. Another one would be Zim, right? Earnings was like yesterday, but damn, it couldn't stay above 19. So that's it. If you're not going to 23, nope. I'm probably not going to bother with it anymore. So a lot of stocks are in this kind of precarious position. Let's see, NVTS, right? We're back down here again, back down to the twos, back down to that range. RXRX, same thing. Now we're back down to below this range here, right? So theoretically, this is the place you would buy and then try to get back up to 8 to sell, and then if you get lucky, it'll shoot back to 12. But maybe that won't happen until another couple of quarters, so it's not worth it. I'll look for a short. Oh, you're gonna do shorting? All right, I'll see you guys. Yeah, I don't do that stuff, but if you're looking to short, yes, this is the time to do it. But I would rather do small caps. Ulta is probably too big cap for me. Yeah, because there's always going to be someone that's trying to buy it up. Small caps are just easier. When they collapse, they collapse big time, like this, right? Okay, let's see what else. I think IoT did some earnings too, didn't it? Yeah, this one was bad. Yeah. IoT. This is Samsara, right? Yeah, somebody told me to look at this one. I said, well, yeah, okay, it's above $28 from June, but it doesn't really have a strong trend, does it? Right? You look at the weekly. Yeah, it's weakening from November to February. It did this. Yeah, okay. Okay, nope. Sorry, this ain't it. Yeah, the good thing, RX. No, nothing happened. It's just the small caps decide to die. That's it. That's what happened. You can't fight the trend of the market. Once the trend of the market, if IWM couldn't break out here, if biotech couldn't break out there, you're not gonna go anywhere with RXRX. Sorry. So yeah, you're just gonna follow the market. So that's why Jerome Powell really screwed it up back here in December, right? The only way you get a market push like you did in 2021 is Jerome Powell said, we're going to lower rates, we're going to extend the economy, we're going to keep it going, we don't care about inflation. That's how you get it up. But because you care about inflation, well, guess what? Prices have to go down, right? It won't be your egg prices that will go down first, but hey, it'll be your stock prices. Then your egg prices will go down. ELF really capped out. I don't know what the heck. ELF sounds familiar. What the heck is ELF? It sounds familiar, though. It does sound familiar. What the heck is this? Oh, yeah. I talked about this. Yeah, because I saw Ulta and like L'Oreal and yeah, a lot of other. Yeah, ELF. Ooh. Yeah, ELF. Sorry. Yeah, ELF is kind of like a boutique type of company, you know. It's very specific, has a very specific market. It's kind of like the energy drink, CELF, like Celsius. You see here with earnings, when it announced that it bought a company, it went slammed its head right in 32. Now it can't even get there. Maybe this is a good short at this point, because if CLF really has a tough time getting to 32 again, then it just starts rolling over. Wow, this thing would go back down to $2. Yeah, this thing could be, the energy drinks ain't gonna go well. Then this is over for sure. People aren't gonna buy energy drinks as much in a recession. So if there's a real recession, this sucker, it'll be in $2 by next year probably. Yeah, could be this one definitely. Yeah, there's a lot of potential right there for a short. Oh yeah, I know ELF. I know the story about ELF. Yeah, I know. But that's a high luxury good type thing because it's very select. It has a very select group of customers. If people can't do that, they'll go to Ulta, and if Ulta can't do good, guess what? Yeah, you're not gonna get it. And L'Oreal and all the other ones. L'Oreal. This is like this is a European stock in the open, like over the counter though. I talked about it once, at least a couple times, because that's like you look at the makeup stocks, they lead everything. So when I said, so on that stream, I was talking about all the makeup stocks because I said like all the earnings for all the makeup stocks look like trash that week, because most that whole week there was a bunch of makeup stocks that released earnings. And I saw all the results were terrible. When I saw that, I was like, "Uh-oh, that's just like tells you next year is going to be a bad economy." Because yeah, this will lead. Once you see this thing go down, yeah, everything else will start following with it. Hey, what's up, Solid Snake? Okay, so I gotta. Oh man, I got a whole bunch of things to cover still. Let's see, covered that. Market crash from oversold. Okay, good. Okay, I covered most of everything I needed to cover. So let's look at the Mag 7 stocks. Okay, let's one at a time. Look at Apple. We looked at Apple, didn't we? Said this one weak, 12%. So that looks terrible. It's probably going down to 194. We're at 110. I mean 210 right now. Okay. Next one, Microsoft. Microsoft, terrible. Looks like it's about to break this one, huh? So let's say it breaks to 376. Then see what the next one. 345 is the next one. Okay, this one has a significant area. Yep, 345, 342. How about that for Microsoft? See, Google. GOG. I use GOG. Okay. So it might go back to 150. It's at 164 right now. Let's see what else. Meta. I think Meta's been doing pretty bad. Okay, let's see. It still has its trend intact, but yeah, it lost a lot of its price from 728. It's at 590. Okay. I don't know about this one. I guess we'll have to see if it can hold 525 or something. Next, Amazon. Let's see, Amazon. Uh-oh. It already went through 200. Okay, we'll see. I think, yeah, when you look at all these charts, it's going to have to bounce. So Netflix, it's not part of the Mag 7, I think, but it's a good proxy of something. Netflix is still okay. It's doing okay. 890. All right. So maybe it'll hit like 800, 700, 800. 768. All right, maybe. Nvidia, that's the one I told you guys to get into this on Monday. So it's done quite well. Today it was only down 0.14%. Very good. So I think it will try to recover. So I'm in NVDL. So I bought this on Monday at 36 something. So let's see if it can climb all the way its ass back up. So NVDL 2x leverage. Let's see what the other one is. Tesla, I said buy on Monday. Let's see, 219. It was only down 3%. Not bad. Okay. So let's see if it can hold up and get back to 300. So I use TSLR. So you got it at $11.80, $12, something like that at the lows. So see if it can get back up. Maybe I'll get lucky. It'll get back up to 20, but who knows? Tomorrow might be hell. Okay, SOXL. So get at $17 around there. Okay. It held up today, -1%, so not bad. even though the QQQ itself was down 1.8%. Yeah, we're at the last legs. If it breaks here, that's no fun. You're gonna have a terrible Monday. SPY down at 550. Yep. So the Wyckoff guy said 530s will be the next target if it can't hold this one. So let's see. That's here. That's this blue area here. So that's where we're going if we can't bounce back to 580 or 570. Okay, on the SPY. All right, that's it. I think that's it. I covered it. Covered as much as I can. Nvidia, that's it. What else? Okay. Netflix, I covered. I think those are the big ones. Yeah, Microsoft. Let me check Avago. So Broadcom, let's see. Okay, still holding there. Whatever. Intel. It's still in that range. Intel's still in that range. Yeah, it's still stuck here. It doesn't matter. It just goes down from 20, goes back up to 24. Eventually, it'll have to do something. Either break down or stay in this range. It could break down if it's pretty violent. Oh, that's terrible, though. If Intel breaks 20, it has to go back to the 2008 lows of $12. Okay, if Intel gets to $12, if you're lucky and you got $12 on Intel, definitely buy it. All right. So I haven't been like telling people what to do with this guy, because ever since like July, people have been saying like, well, should I buy it? I'm like, no. This could be the time now, because now that we got a clearer picture, yeah, I can see 13 and $12 now. So yeah, hold your horses. That'll be great buy. Yeah, that'll be great buy. Okay, that's it. So the last video I'll play is from Samantha LeDuc. She presented yesterday. I think she'll cover a lot of topics, and I don't think she's bullish about the whole budget stuff this weekend. So I don't expect a good Friday or Monday, but if Friday is okay, maybe we'll survive Monday. But get your cash ready for Monday if things go bad. Okay.
Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Greetings, everyone. Welcome to Macro to Micro Options Power Hour. I'm Samantha LeDuc, founder of LeDucTrading.com, joined by Hans Albrecht in a very nice blazer from Canada. Yes, the other coast. I am very glad that you joined us so we can talk a little macro. Definitely there's a lot going on here, but we've got some quant to dig into as well. Not just technical and macro and sentiment. Lots and lots of macro moving headlines, of course, but we're looking for a bounce. I would say more than that. We're actually looking for a bounce instead of a trounce, because we are still very much on pivotal support that could very easily give sway, and we're hoping that we get some consolidation here, and then those mechanical buyers, price insensitive buyers, start coming in and giving us a short covering rally. That is what we're going to talk about today. And Hans, I know you've done some work on this regard, and I just talked about mechanical flows, but otherwise there really isn't anything calm in the macro event risk side. We have government shutdown potential. We had a cool CPI, which was what I was expecting. In other words, it's actually falling inflation versus rising. So we're kind of still in this deflationary impulse. Equities as well. Jobless claims last week, not so bad. So we'll get another chance to look at those tomorrow morning, Thursday, jobless claims. And then, of course, next week, FOMC. Not a lot is expected. Mostly, Powell has one lever, which is the QT of the balance sheet, the Fed balance sheet, and whether or not they pause that to give the market some breathing room. Okay, 95% chance of no rate cut. We would really have to fall off the cliff, if you will, precipitously for them to pull forward a surprise 25, let alone 50. We're looking at that later on. But I think right now, we don't have any policy intervention coming in. And that's the big thing, right? So if Trump was to come out and say, oh, I was just kidding about tariffs, Bessent had some power, honestly, in Treasury general account and or ability to intervene. I think he would. But with the continuation, the reconciliation bill that's coming up and pushing the deficit not only to September, but the debt ceiling, I should say, but also this expansive deficit is just exactly what Biden ordered last year. So it doesn't help the market. And we've already started seeing money go home. The dollar is dropping. Again, that has definitely cliff dove, and it is for good reason. Re-rating of concentration risk, absolutely chaotic kind of political agenda. And then, of course, money's just going home. They're being incentivized to chase yields abroad, whether that be more Europe promises of stimulus or Japan higher yields. And of course, China is doing a lot to support their capital markets right now and their tech dominance run. So let's talk a little bit about the flows. Hans, what do you see?
Hey, Samantha. Hey, everybody. So yeah, coming from what I'd like to call the North Coast, or what you guys refer to as the 51st state in Canada here. So we'll have to see how that goes. I'm going to be running for governor of the 51st state, hopefully when that happens. So yeah, no, look, it's been interesting. Poor Joe Biden, he had 2 years of 20 plus gains and it wasn't enough to get him reelected. So here we are with you get what you get. And that is a whole bunch of bull in a China shop. China getting smashed around all over the place probably makes some people pine for the days of Joe Biden. So it is what it is. He's got this vision, and the vision it's fascinating to me. I almost feel like we're in a little bit of an experiment here, really something that on the one hand, he's kind of got this amazing vision, and he sort of, he sort of harkens to the days of the 60s and the 50s and manufacturing and bringing back manufacturing and all the, the ability to own a house and a white picket fence and all that stuff. But we'll have to see how that turns out. But in the meantime, it has caused a lot of problems in markets. And I borrowed your quote several times over the last week, Samantha, just saying that light at the end of the tunnel, it's two kinds of light. I was sort of saying from a structural and derivative standpoint, we talked about the short Vega. Thank you that someone just said they'll vote for me. So there are some structural problems within the derivatives market. We talked about that short Gamma, short Vega. And so I said, well, and certainly technically some issues there. So I said, well, from a technical standpoint, from a structural standpoint, we've got some, light at the end of the tunnel because we've sort of had a big washout. The RSIs are way, way overbought if you put much into that. But from a longer term fundamental standpoint, the light at the end of the tunnel may be a freight train, as you said. And I think that's sort of the world that we're in, right? Where we hope, and I'm going to show you guys in a moment how there is a little bit of softening from the vol side of things in some respects, which can make us somewhat positive, maybe to be expected after such a very swift and vicious sell-off. I think the worst on the Nasdaq since 2022, I think it was. So we've had some very, very quick downward movement. A lot of people have been caught off guard and are having to deal with that, given the complete 180 that we've had from post-election, which was Trump's going to support markets and everything's going to be wonderful, to Trump is literally quite doing the opposite and saying we're going to toss Wall Street under the bus for Main Street, which Main Street's going to feel some pain as well. But this is the sort of mantra. Well, we're putting Main Street first. And so it remains to be seen if that kind of works out over time. But we are seeing a little bit of a softening of vol lately. I did notice this week we had a couple days there where the markets were down slightly, the VIX was down, and then again today we see the VIX down quite a bit given the small rally. I think last I looked we were up 30 or 40 points on the S&P. So we are seeing a little bit of a relaxation in fear levels. Remember that a VIX 27, 26, I haven't got my calculator handy, but we're probably pricing in about 1.7% of movement per day in the S&P, and that's quite a bit of movement. So if we have if we continue to have some days that are a little less breakneck, and I don't know if you noticed the ATR, Samantha, but the ATR was actually hit higher levels on the S&P, that average true range, than we saw in August. So August was that big swoosh down and all the way back. And if you didn't check your statement, you didn't even have to check your statement because it didn't matter. This could be something a little bit more durable versus that V recovery. It could be a little bit more of that rounding bottom recovery and hopefully not new lows. But this is a very different scenario. But we are seeing just a little dialing back, and we can talk about that in a moment.
So just to talk about your internal kind of volatility, I wrote about that. This is actually a really big deal. And we're not even going to talk about the Trump 1.0 versus 2.0 because everyone's firmly over that. But as it relates to inside the not only has the S&P retraced all the way back to the July highs, which was something that I was gunning for in a particular intermarket tell that I follow, and I'll show that in just a minute. But we're there. So we've actually gone through it, the July 16, 2004 highs. But and it's a lot of money, profit taking. There's a lot of money going home, leverage unwind, and there's still more to go. But for right now, I can see some examples of stabilization, and I have kind of gone through those and specifically shared those with clients. So I might as well kind of get you a little hit here, which is key levels in VIX, which I have identified very, very important levels in VIX. The dollar yen has to stop going down and move a little bit higher. 10-year yield also needed to stop going down and move a little bit higher. And yesterday we had a nice 2% reversal intraday, which was lovely. So, and then CPI, it came in cold. So we had a little bit of a boost there with sentiment. And we're definitely on some monthly support, and value, it was absolutely trouncing gold. I mean, massively. In fact, we had a big divergence of 14% down in high beta. That's really large. And 1.4% for low beta, positive. So there's a real big divergence there. And this is to my big overarching, we don't have a great line in the sand yet as it relates to stability, because we're right down into what's called a Fed liquidity pocket. We break through 5,600, this is the E-mini, we're actually going to pick up speed to the downside. So the fascinating point is, when I posted this for clients yesterday, and this was taken on the 11th, I'm like, we're right at this level of bouncer trounce. So I don't think it's going to be the convexity rally that we had in August 5th, and that triggered a short covering rally, but maybe we can get some stabilization and some reversal, like you said, in a bottom and before we start to roll over again, because there'll be another time to actually give up the ghost. But for right now, that's a key consideration. And a lot of folks might not do this, but I had warned in this spread, which was basically intonating back on the Tuesday, the 18th, that it was about to come out of this kind of diamond shape and dump. And we did. So all the way back through to monthly support at that kind of 5,500. It's a very big move, and yet we see nothing. I see nothing yet in any stabilization as it relates to buyers really coming in. That's what it looked like on the 19th, Wednesday, when I showed this here. And this is where we are all the way back down, well through the election and all the way to July. And I think for the most part, this is the reason why. We got a little bit of support yesterday and a growth bump, but value has still far outperformed momentum. And they're hoping right now that it's going to come in and momentum's going to get more than just a one-day short covering, dead cat bounce. I'm very suspect.
You don't think that there's some reason to get a little bit excited about growth that has been trounced, and people perhaps rotating a little bit back into those balance sheet heroes as a place of refuge almost? These are companies that are going to do well. Sure, they're spending beyond reason on CapEx probably, but these are very strong businesses. And if indeed this growth scare is in there, cyclicality aside, can these be a place for people to hide a little bit?
I don't think so, but it depends on everyone's time frame, right? So you're talking active investors versus maybe swing traders versus chasers that are obviously looking at every opportunity. I'm much more focused. My bread and butter is swing trading. So I'm looking for something that's going to be durable for a few weeks that turns into a few months, and trends that are a few months that turn into a few years. But I still run a live trading room. I'm still going to identify, right, what to look for traders that are also trying not to get shaken out of their hedges. So we kind of talked about this intraday volatility. Case in point, I was looking for the chart, but I couldn't find it right away. So I kind of, I filled the air, but this was the chart I was talking about. This is the intraday volatility starts from inside and then moves out. So this is just Monday, Tuesday. And look at the swaths of, ginormous, like you were talking about, the ATR, the average true range of an intraday chart is very large. And you know that I've also been, and I still am, bullish volatility for 2025. So it's not just intraday, but I think this year, and it isn't just because Trump is, chaotic in his on again, off again, on again, delayed, on again, off. The point is, it was time. We were just extraordinarily overvalued, and it was ready to obviously take some of the air out of the balloon. Now we have Trump, who really wants money to go home. He wants the dollar to fall. Basent, again, wants to backstop the bond market. So these are coordinated efforts to hopefully, in time, drive down the dollar, help the trade deficit in order for U.S. exporters to get their, manufacturing back on shore, so supposedly, and drive this private engine growth mechanism. But that takes time, and he's not really, helping to coordinate that. In the meantime, market is very clear. Money's going home. The dollar is absolutely a mess, and it will continue to fall, by the way. It's not serving as a tailwind right now for equities, but it will for earnings for those companies that do derive a lot of revenue abroad. But this is backwardation, right? We didn't just fall in garden variety for a one and done like August 5th or like December 18th when we had a big, 3% down day. The whole curve is now in backwardation. So this is more
I'm
durable.
noticing that. Yeah, sorry, Samantha. I'm noticing that actually quite a few stocks. I'm looking at some of the even sort of 9-10 month vol having reset quite a bit higher, looking at something like the XLF in financials, for example. Really almost 52-week vol option pricing levels in those areas. So there is some evidence that there is almost there's a durable sort of feel to some of this volatility, as though the market's kind of digging in and going, okay, this is going to be a problem for a little while now. So that's going to make for some interesting opportunities on the Vega side of things, short Vega, taking advantage of a drop in volatility at some point. I don't think we're there yet. And I agree with you. I think any pullbacks, so there's always this sort of, one of my favorite sayings is low VIX can be expensive and high VIX can be cheap. And I think that maybe we're probably in the latter for a little while now. So if we do see a pullback, we saw a nice pullback, starting to see the VIX, if you can chart the VIX, some people say you don't, but I certainly think you can. It starts to break down a little bit. Well, yeah, you like to as well, Samantha. I'm 100% in agreement that you can. And if we kind of come down below 24, we could revisit the low 20s, and then I think that's where things start to look a little bit interesting again as a rehook. So I'm almost wondering, and this is sort of my many-decade trader intuition, is that we get a little bit of good news that gets us one of those blow-ups towards the upside, because when we talk about short gamma and short Vega and all these things, it can work to the upside as well. We've seen it work to the downside. We showed very clearly over the last couple of weeks that chart showing through 5,800, we've got some potential big problems. Boom, it happened. Sure enough, it played out. Now we're starting to see market makers maybe get a little bit more replenished down here. We're seeing CTA selling slow down, vol targeting, so the funds that need to sell when volatility rises and that need to buy the market when volatility drops. There's some good evidence that is starting to slow down as well. So there's some evidence of support out there. We're seeing fixed strike vol come down, which is good. You don't want to see, when I start to see that fixed strike vol, basically those out of the money puts basically rising in a sort of more pronounced way than they should versus downside movement, then that makes me think that people are still offside. We're seeing the opposite of that. Things are starting to calm down within the structure of the VIX. Yeah, so here's where we are. This is your A to B, basically where we are living right now. The US economy today, and then where Trump wants us to be: smaller government, bigger manufacturing, lower imports, etc. And this is I've called it the Valley of Death. I borrowed that from an option strategy, from a backspread strategy where you get that value. It's probably a little bit extreme in terms of the title, maybe more like a valley of uncertainty. So what we don't know is this part here. How much work is it going to be to get from A to B, if B is in fact even possible in the long run? So, that's basically what the market is dealing with. And a market, as I'm sure you'll agree, was kind of priced to perfection in many ways, with, record profit margins for years and years. This is what the market is having to deal with. It's not that the world is going to end. It's that markets, performance comes at the margin, as I always like to say. And at the margin, things have very, very much changed. But we're seeing this AUM in those leveraged ETFs. And remember, a lot of those leveraged ETFs are technology, Mag 7, semiconductors. So a lot of those kind of faster moving areas of the market, as that comes down, we start to see that there's a little bit less selling from those particular products. So
I have to show this real quick while you're talking about that. It's something I included literally last night with my market timing, with my market trading room notes. This is what you're talking about. These levered ETF rebalances are in the 1 percentile. They have sold a lot, is the translation. So
exactly.
This is a big point of saying, okay, so those, vol control, again, I've got another chart for this right here. Exactly what you're talking about. The systematic macro strategies of vol targeting, CTAs, risk parity, they have sold a lot. And that's what you're saying.
And that was, remember last week we showed this sort of, this chart that showed basically there was selling from many of those areas of the market in a down market, in an unchanged market, and in an up market. There was just, and we saw that every pop was met with a drop because there was just this massive supply of stock into the market. That is starting to calm down a bit. Now there's a little bit of a vol echo given what's just happened. So maybe there's a little trepidation in starting to move to the upside, but there is a potential. I feel there's the potential for a good 150 to 200 point move up at some point here. And that's where I was saying a little bit earlier, my intuition says we're going to get a little bit of good news that gets people back in and going, hey, things are starting to get okay again. And I worry that is then going to turn into a cascade that takes us down towards 5,000. That's just my little...
No, this is exactly what I wrote for clients. I said, okay, more intermediate term risk level, I have SPX 55.25. This is before, right? So we're already down in that neck of the woods. Anyway, for this leg, and then we have this kind of counter trend bounce, but I don't think it's going to be so meaty because there's no policy intervention that is expected to come in. Anyway, and the next thing I'm looking for is a major crash support level at 52.65. We're not there yet. We're still working out these mechanical flows. But I do have to put one thing in perspective though. As bullish as it looks to have these levered ETFs exhausted from their selling, as bullish as it looks for the guy that I just talked about there, Marco Polanovic, he's like, we should have a bounce soon. There is on the other side, Morgan Stanley came out, their quant desk, putting out this unless, so they're even hedging their bets, unless deceleration versus last week, it's still kind of chunky, but this is still pale compared to projections should leverage come down to levels we saw in 2022. That would lead to another 225 billion of supply from this group, talking about the CTAs, the vol strategies, the risk parity. Volatility controlled strategies would be the biggest sellers. You do have to kind of say, oh, it looks really good for a bounce, but then what happens after that?
Well, that's it. And everybody listening, just, no one knows exactly what's going to happen here, but that could be the big suck everybody in moment where we do get this little bit of a vacuum. And I'm going to show you guys, and we can see it here. We've got VIX Vega. So we can see the Vega, meaning this sort of tendency for things to panic to the upside in VIX and to the downside in the S&P. That's subsiding a little bit. We're having some of this negative, this accelerant, as I often call it, this sort of kindling that's sitting there ready to catch fire, that is disappearing a little bit as compared to last week, moving on to this week. And as we go towards April, we start to get rid of that short put from the caller, right? The JPM, here we are again talking about the JPM caller. Isn't it amazing? We're talking about the call side up around 61, whatever it was, 50. Now we're sitting around the put side where there's that significant dealer short gamma.
55.65, isn't it? That part of that put spread. So we're right at it.
Yeah, you're right. 55.65, exactly. So it's amazing. JPM's really got it figured out. I know it's just sort of, there's no discretion there. It just, they do what they do, but it just so happens that we spent these, I don't know how many expiries in a row we've kind of spent around these important spots. Usually it's the call, right? Now we're actually sitting by the put. We haven't seen that one in a while.
That's the point. We had 2 years where Nasdaq doubled from January 2023 until the end of 2024. And they basically rolled into their upside sold call every single quarter. I don't think without exception. This is the first quarter they haven't. So we definitely have a big change as it relates to it.
That's right. It's a big change.
But I believe very, very firmly it's money going home. 17% of the US equities market is owned by foreign interests. And money is going home. They're incentivized to go home, period. So we definitely have more risk than reward on the upside. Although I know that's not where most analysts are still consensus bulls. Not one analyst has come in with a sell side, with the sell rating on NVIDIA, for example, despite DeepSeek coming in and deep sixing all of the semis. The semi sector has been atrocious. They're still not throwing in the towel. Not one has come in with a sell side, despite the fact that Microsoft is cutting this and competition with Quen from Baba or Manus is the newest one. So this whole AI euphoria that has hit data centers and power producers and software and hardware. Apple was supposed to be the golden child, receiving all the benefits by not being a hardware company. Nope, they're right at that 220. Exactly. Right. So the point is that I was re-rating these companies a month ago. We talked about this. Recession risk was not priced in. So now they're starting to say maybe maybe we should re-rate these earnings plays like Delta coming in and saying, oh, by the way, and then the airline sector just dumps, but it was already starting to. Or American coming in yesterday and saying 50% of our government contractors who travel often are gone. We literally just lost 50% of our huge base of business. So my point is, they have not re-rated. The market re-rated before the analysts did. They'll catch down.
Yes.
Anyway, go
100%.
ahead.
And that's what I'm talking about. The two kinds of light, the light at the end of the tunnel versus the oncoming freight train. We have this ability to kind of, for structurally, as we're talking about here, I'm showing VIX call skew coming off. So that broader market sort of relaxation, maybe unclenching of vol stress is kind of happening a little bit. But to your point about NVIDIA, I mean, the entire world got into NVIDIA. Everyone's into it. There was Torsten Slok who's talked about this massive leverage play on NVIDIA, everybody coming in from around the world having to have a piece of that. That is unwinding. And what's interesting is that the one point that I hear you making is that, listen, this is just starting from a reality standpoint. There is the market getting ahead of what's happening, and now we're pausing for a moment. But then there's the reality of, think of the headline risk that we have at this point. We just had Dick's Sporting Goods. We had a number of companies just come out and go, this is going to be not great. How many more of those are we going to get? So this is going to be our reality as traders, as investors, is every morning, how many companies are going to come out and go, we have completely changed our tune in terms of our outlook. Who was it the other day? They said, well, it was Yardeni. He said, in January, he was like, we're not going to have a recession for 10 years. Now he's like, we might be in one. And that's okay. I don't fault somebody for flipping. Good for him, because move your feet, change your mind. It's okay. Don't stick to your tune if you see things changing. But that is just one small example of things really changing out there. And my second point about this is that even though I'm seeing a relaxation in the broader market, a little bit of, from CTA, from vol targeting, from VIX, from skew, in single name, the skew is still very high. So I think there's still some risk. I'm going to hedge myself. I apologize in a moment, but there's still some risk because a lot of people have been sort of buying those out of money hedges in single names. And that still places a lot of pressure from a dealer standpoint to the downside, that negative gamma. And I think if we do get this bounce of 100 to 200 points or whatever it is, I have no clue. You'll know better than me, Samantha. I think there could be an interesting play there in maybe doing a little bit of upside, maybe buying a call spread in some of these names. I think something like NVIDIA, I don't think I have the chart here, but I had a chart that shows the negative gamma to the upside on NVIDIA. So if everyone just says, listen, we better go hide in growth stocks for a bit, and they've overdone it in value. I've been a big proponent of getting into those low vol stocks, but you can see some of those starting to keel over as well now. So if there's a little bit of a durable move back into growth, I think you could see a nice little run into growth fueled by negative gamma to the upside, which means there could be a little bit of an air pocket in something like NVIDIA and a couple of these other ones that have been trounced, like, I don't know, maybe a Microsoft. Maybe there's a beautiful play in there on a temporary basis, because I agree. I think we run into the wall of reality at some point here, where there is going to be nothing but negative headline, analysts re-rating. We know how the analysts are. There's going to be a lemon show at some point where it's going to be one after the other falling off a cliff going, oh, wait a minute, I better get on board here.
They're not willing to concede yet. They're not there yet. A 10% pullback is nothing. It's garden variety for most market practitioners. So they're not worried about this. They're still buy the dip. But it is very interesting to have Citibank come out yesterday and say, we're going to downgrade US stocks and upgrade China stocks. And then today, JP Morgan came in this morning and said, we're going to downgrade US stocks and upgrade China stocks. They're a little late. China's already done a massive move. And we already had, SPY, of course, down 10%, Qs more. But now they're starting to look at this as it isn't going to be so easy to get economic growth with the current macro backdrop and with earnings as good as it gets now going underneath, a little bit more suspect, kind of views. So anyway, this is definitely a time to be actively trading, actively protecting. It doesn't mean we're going to not have a fabulous bounce. I don't know, to be perfectly honest, until I can see my intermarket stuff turn, which is why I have been very persistent in this bearish view, because I have not seen the buyers step in. I have not seen they're hammering, puts, in other words, they're selling puts and buying calls, where we had that really big big convexity short covering rally in August 5th. We're not that situation now. I think we're going to have to base and have some macro trigger to get us going. And right now we have Besant saying no policy interference. In fact, we have to detox. Trump saying we should look at the market like the Chinese do, 100-year view. Point is, we don't have the same vibe that we had before of a nosy Fed, Treasury, and White House combined policy intervention narrative.
Nosy, right.
Very, very much in the business of the market to make sure nothing happened to get their guy or gal elected. That's off the table now. So I think it actually makes some sense. The market is orderly in its selling, and we can have these counter trend rallies. I don't even want to call them rallies. I'm going to call them bounces, because to me, a rally is we take out the highs. And the question in here is, are you still thinking of one more high, then we're done, or we're past that point now? The only way we're going to get one more high and we're done is if we get policy intervention. And right now, the policy intervention has been stimulus in Germany and Japan and China, but not here. So if the U.S. changes its tune, Fed does cuts and halts its quantitative tightening of its balance sheet, that's a policy intervention. I don't know, honestly, what Trump and Besant can do, since they're right now embroiled in this, we must protect the bond market, and yet they're passing this ridiculous, they're trying to anyway, this ridiculous budget. And that's a really good point. It's difficult to find anyone not looking for a bounce high, makes the Senate vote extremely risky for a flush lower into the weekend. Completely agree. And in fact, I think Trump is okay with that. Like I wrote about that a few weeks ago. I don't think he's even worried about if we shut down, if the government shuts down. They're in fact supposed to have announcements tomorrow. Again, I wrote about this weeks ago, where they're supposed to have, I don't want to call it mass government layoffs, but another big announcement on layoffs. So they're trying to cut costs, but they're not cutting spending. It's not going to work. The market is going to see right through that. Go ahead. Sorry.
Look at this. Elon's got to be licking his chops looking at this graph here. Government share of jobs added for government in the last 2 years. I mean, look at that, 2023, 2024. I mean, if you just unwind a good portion of that, and I sense that there's almost, what was I watching the other day? And they were booing the heck out of Elon. And I mean, he is like, he's a complete villain right now from a comic book. And he's out there with his chainsaw making light of, people losing their livelihoods. I mean, it's not very tasteful in some ways, but it's starting to wear on sentiment a little bit. And we're seeing that in sentiment from not just consumers, but from businesses. And that can really work its way in. I don't know what kind of policy intervention, but it better happen fast and it better be big, because it's working its way into the psyche of, of media and
also CFOs. I mean, just not for nothing, but look at the actual price action of these private equity firms, like you're putting up Apollo. They're getting pummeled. So private equity right now isn't the golden child. NVIDIA isn't either. So this is what I mean by that kind of re-rating situation, where we need a complete turn and or policy intervention to create any type of momentum that can carry forward for more than a bounce. And I am still thinking that I got ripped off from my 272.46 SMH call. It came really close.
You were so patient with that. You held in there.
We hit 270, Hans. And then boom, right in the kisser. So anyway, I know trading isn't a game of perfect, but I was very patient. And then boom, DeepSeek came out, and that was it.
You were close. You were close, though. No, very, very close. Closer than I thought you'd be. So I have to hand it to you. Here's your bearish. Look at this AI. What's that? Sorry?
I said, but that's not the point. The point is, are we going to have a chance to go up and fill that gap? And that's what the question is. Do you think we're going to actually?
And that's the thing. We're getting so negative that would you put it past this market to have a massive face ripper rally here, where some of that negative gamma is going to start, and the leverage ETF, some of that's could work the other way to kind of suck people back in. But I think that could be a golden opportunity to at least get very, very big on hedges, a little larger than you would normally. We monetized a lot of VIX hedges this week. I left a couple on. I have a VIX 25, 30, 35 call fly that is sort of sitting right at the cusp of maybe being able to make money. But I feel like the VIX has got a good chance of kind of hanging in here. Of course, when you trade those products, you're not trading the VIX per se, you're trading the futures, but they're going to converge next week on expiry in the front part of the curve there. So it'll be interesting to see. But I have had some triple Q hedges paying to the downside, some 2x3x1. So playing with those kind of structures these days, a great way to play these moves, guys, is because volatility is so high. Those broken wing butterflies, those butterflies are a really, really nice way to have some directional delta, have a little bit of exposure to a move up or down, but everything's very expensive. So they kind of minimize your Greek exposure in a sense. You don't get, obviously, if you really have conviction that we're going to drop, you can buy some puts. And if you're right quickly, you're going to do fantastic and you get the full convexity. But if you're just kind of stick handling things back and forth, I really love those broken wing flies. Here's your bearish sentiment. So some conflicting data. I don't know what you'd think about this, Samantha, but we've got this AA bull and bear as low as we've seen it since the lows of 2022 in that sort of bear market year that we had. Yet at the same time, if you look at the percent of stocks above the 50-day moving average, we kind of still have a little bit of room to the downside. A lot of stocks have done okay, almost a little bit of, there's a little bit more room here to the downside. And the other one's sort of showing a very, maybe it's a little bit more sensitive to real-time data. I don't know.
So I spent 4 hours. This is my thing. This is like what you're pointing to is what I exhaustively research, like exhaustively. So I have my set of intermarket tells and a bunch of, North American investor manager, active. Those are just some. And then I compare them to other periods. And I look at breadth, NYSE and Nasdaq and SPY and the whole thing. And then I look at everything, cumulative volume, the quant, the option market structure, et cetera. And then what, of course, the mechanical flows look like. I put that together. I spent all day, Saturday, probably 6 hours putting together a whole bunch of charts because honestly, they only really say anything at inflection point. And then I put it together. I did a video going over all of these annotated charts. Point is, it still says volatility's not done. Now, I'm not talking about for a bounce. I'm not talking about I set that up just the day before yesterday going, okay, here's what I'm looking for, a little bounce. And then yesterday, here's what I'm looking for, a cold CPI. So here's another little bounce. But that's just for a day. That's not like an overnight boom. But big picture, I'm talking about when is it safe to close hedges and buy again? That's what I look for, is that more durable swing long. And by the way, when we had the August 5th convexity rally, it was wow. It was huge. It was ginormous. There's nothing like it. It's VIX 65 pre-market, and then the buying just started and didn't stop. This is different. This is very broken. Underneath the market, we can have some nice little bounces, but we're in a huge topping pattern now. So at the time that happened in August, we were still trending up. So it was very easy for a convexity rally. Honestly, we also had FX currency as the trigger. FX was yen carry trade unwind, kind of see where positioning was for that particular asset. We have everything going on right now. We have the dollar dumping with a larger than 4 standard deviation move, which in the long term is exactly what the administration wants, but in the short term is extremely disruptive, and it's pushing foreign investors out. It's shaking up regular investors. It's a lot of volatility in a very short period of time, as you can see intraday I've shown, and as you have talked about as far as, this is historic. The point is we're actually starting to roll over with the macro tailwinds to roll over, with the fundamental tailwinds to roll over. It used to be AI or quantum or whatever, and now that's going, well, actually China is eating our lunch. So we really have to be more realistic. So the point is we have lost a lot of the story stocks. We have lost the macro tailwinds. We have a new administration that needs to do the, rip the Band-Aid off kind of thing and make it very painful to hopefully have pleasure later. So there is going to be these reflexive, not convexity, but I think more reflexive bounces into resistance. And we're going to have this process all Q2 unless we just dump down and then really it's just way too yummy. But right now buyers have stepped away. All of my intermarket analysis is still basing, which means it's oversold, which means buyers have not stepped in. They have stepped away. So until buyers actually step in and then we have follow through, there's nothing for me to get excited about. We could do this for another 6 weeks. We could go sideways for another 6 weeks, shimmy around that 200-day, which many people are all excited about. We're going to bounce to the 200-day. No, we can actually take that out and crash lower. Markets crash from oversold, or we could go sideways for the next 6 weeks until we get another trigger, bullish or bearish. So it's all about time frames.
Well, and we really haven't had that big whoosh to the downside in vol markets. The VIX has been, I don't even think we hit 30. I think we hit kind of high 27s, 28. So if you kind of compare that to that ATR was higher than it was in August, but yet on the VIX side of things, which I'm a little surprised about. I have to admit, we've seen such a high beta of the VIX to S&P downside, and we saw that in August and September and December. It's rather been sort of orderly, especially considering the short positioning in those upside calls for dealers. So a little bit on the kind of orderly side of things, even though it hasn't felt great for equity holders and certainly people in Momo and growth and Nasdaq. I almost wonder, I found this, there was this quote here that I saw somewhere. Is this what March, this is somebody on Twitter saying, oh, is this what March 2020 felt like? Was it worse? I wasn't trading then. I wonder how much of traders just kind of sort of live by this mantra of buy the effing, because it works every single time. And it really has, right? I mean, you have not been wrong in buying the dip for so very long. Potentially, especially in light of all the things you're talking about. This isn't coming from one angle, it's all angles market. It does what it does, but almost can't throw much more negativity at this particular situation. I think that's the weight of that reality that markets are having to deal with right now. I think a lot of people who've come into the market over the last few years just have no clue what kind of severe downturn this could very well become. So I hope I'm wrong, but really, I wonder, in your opinion, is it a fraying of American exceptionalism on the one hand because of that unraveling of the AI and, oh, here comes China, here comes DeepSeek, here comes some of these other, maybe we can do things for less and for cheaper and more efficiently. And is it somewhat self-imposed deterioration of American exceptionalism because we're suddenly Trump is, for better or worse, or for whatever the long-term vision is he starting to destroy some of that himself, destroy relationships with other countries, which relationships are important. Globalization is a reality. So is it a bit of self-imposed reversal of exceptionalism as well as AI maybe not pulling back on that exceptionalism as well?
Yes, but let me first show you this chart because we were really in the throes of North American active investors managing money, worried about these policies. They would be absolutely much further down in there, like you just showed the AA, the bears, whatever it is, that bear bond version. This is actually the one that shows they have not even come close to the August. So back in July and August, we were way down here. They were very quick to dump. We still haven't really sold off as far as investors are concerned. It may be, I don't even know why. They don't think it's a worry. We're still, American exceptionalism is the best, but we still have not even sold off in some of these indicators. Let me just kind of show you also when you were talking about breadth. This is S&P percentage of stocks above their 200-day. Back in August, when we had the yen carry trade unwind and Nasdaq fell 15%, semis fell 25%, Nvidia fell 35%, we still did not pierce 65%. What are we right now? We're down in the 45 handle. Much worse breadth than we were after the yen carry trade. I could go on and show you that this is still a risk. One other thing that folks aren't really keyed in on is because credit spreads have been so tame, and that's one of the reasons why we have this outperformance until COVID. Speaking of COVID, for all of 19 and into and before COVID, credit spreads were also descending until COVID, and then obviously blew out. We have been in this very controlled downtrend as well for tight credit spreads. Credit leads equities. We don't need much as a trigger to actually get back above that trend line and push higher. So I still think the risk of a macro event risk is actually pretty evident. And to answer your question, the policies that are more macro driven as a way to decouple from the dependency on China, to decouple from the war machine that is really a lot of money laundering to Europe, although Trump is still very pro-war as it relates to Iran. So we're just trading one for another potentially. But the policies as it relates to getting manufacturing back to the US is going to be short-term, very destructive for our currency. And that's good as it relates to being able to have an advantage for US exporters, but it's very bad as it relates to the structure of the money that has flown into the US because of our strong dollar. So we're kind of trying to thread the needle of what is going to excite to keep money here. And right now they're disincentivizing. They're actually wanting money to go home. So less demand of US dollars. It doesn't mean we're going to dump precipitously, but I will warn, and something that Jeffrey has been on often, and this is our amazing classical economic economics advisor, Jeffrey Fouret, who is very much entrenched in what happens under fiscal dominance, what happens with trade deficits, what happens with these policies that are dollar bearish, oil bearish, yield bearish. The problem is, if they do not fix the deficit, we start to increase the rate of interest that is charged on our rising debt. We get another 2 basis points higher, let's say 6%, which is a Sem Carson and some others have said we're going to 6%, we're going to 6%. That will destroy the US. It will destroy the US. You get 30% of interest on revenues and the currency will plummet. That's only at 6% for the 10-year. That's a big deal. The market's starting to kind of, hey, okay, money's gonna go home. That's gonna hopefully help exporters. That's not the point. If they don't get control of the deficit and this interest on revenues equals 30%, in other words, the 10-year yield goes from 4% to 5% to 6%, the currency in past has collapsed in other occasions over history. That has always been kind of the Bitcoin anti-American hedge, if you will, right? They're worried about the devaluing dollar. By the way, Bitcoin will be also useless. Crypto will be gone. But the point is, that is very much the focus of falling dollar is bullish until it's extremely bearish. And what happens also in the bond market is when the currency fails, US Treasuries are backstopping the value of the dollar. The dollar is used to pay the military, not Bitcoin. So the military is actually what has held our reserve status globally. Trump is trying to dismantle that as well on purposes of reducing war spending. That's actually very good. That actually can help deflate the inflationary impacts that we've had. But not if the deficit keeps rising. All bets are off. So the only way that we're going to save, we're going to be saved, is if in fact they get control of this fiscal spending and specifically restructure and specifically not just cut, out the Doge, the people that are in government, but the programs that are the Congress, the power of the pen needs to actually be controlled. Otherwise, all this talk that we have on a weekly basis about what stocks to trade, oh yeah, we're short this, we're long that, this is a great option structure. Honestly, none of it will matter because the dollar will fall with bonds. The treasury market will have a sovereign debt default, and that's within 200 basis points of where we are. That's what matters. So that's the macro. I don't worry about it. I run a live trading room. We got to chase what we have. We got to position what we see moving. But big picture, Trump is maybe, I don't think he's keyed in on that, but maybe some of this stuff is great, but none of it matters unless we actually get Congress to reduce the fiscal spend. Full stop.
He's breaking a lot of eggs to make some sort of omelet. I don't know what kind of elaborate omelet it is, but I think in the long run, there's look, at this point, the market is in need of any kind of good news. Maybe it's going to be something from Ukraine. Maybe it's some sort of peace agreement that actually sticks. Maybe Powell comes out and says, yeah, we're going to start lowering rates. It's not going to happen right away, but at some point it will. And people will start to see a little bit more the actual light at the end of the tunnel as the freight train disappears. So I think that's the hope. And the question is, well, in that little valley of uncertainty, how deep do we get in this sell-off? And I agree. I think it could be sort of around. I was thinking that the lows of August sort of kind of make sense to me, even from a valuation standpoint. I don't know what do you want to put on there, 260, 265, for the S&P, for the SPY. I don't know where that needs to be, because the question now is going to be, well, where's the E? We talk about PEs, but what's the E going to be? Nobody knows what the E is going to be because things are in complete disarray. There's a lot of what ifs, and of course, markets don't like that. So this is the world that we live in right now.
Well, I think that we have lots of opportunities still, but I do believe that maybe next time I will show you, because we'll be through the next week, which is the government shutdown. We'll have a decision on that. But some very large quarterly candles for anyone who is in technical analysis, because I love the macro. I love, comparing assets for that intermarket blend and then throwing it over to see what I can predict as it relates to movements, which has been very, very helpful in this pullback. Where is the bottom? And I don't see it yet. I don't mean short term, yesterday, today, tomorrow. I'm talking about next few months. Anyway, so the danger of having a bounce is that it gets firm firmly rejected, and we keep rolling over, and the lows just make lower lows. And financials, a perfect example. We just took out massive amounts of profits for the past few months. We just took out all profits all the way back to July in the S&P. That's not a joke. That the charts are busted. They need time to base. They need a macro trigger to move higher, full stop. I'll show you towards the end of the month my quarterly candles, which are also very bearish, but it doesn't mean we can't retrace half of that candle. It means that's literally a bullish backdrop for a bounce. It's high probability that we can bounce and then trounce.
All right, so I think that's good enough for you guys to listen. So we're gonna get those quarterly candles, and we're gonna see how good we can get it. Okay, let me summarize what I'm looking for. I'm looking for Tesla. I'm looking for the semiconductors, and maybe with the internet stocks. I don't know. It took a beating today, thanks to Google, Microsoft, Apple, everything else, Meta. So let's see. Okay, let me go get this. All right. Present this. And show it. All right, so weekly chart here of SMCI. We still are above that curling weekly 18. All right, not bad, not bad. So maybe there's some chance. Maybe there's some hope that this can hold that. Okay. No guarantees, though. All right, let's see. And I'm going to look at the hourly chart. Yeah, we pulled back at 39 here. Okay, well, let's see. Let's see if we could tag 42 again. It did all right yesterday. So that wasn't bad. I like the overall look. But still in a danger mode. Still in danger modes. SMCI, Tesla. Let's see the hourly. Good. Still moving up on the hourly here. It's above its 18. Not bad. Nvidia. This thing's still held together. Very good. Close to that 117 area. All right. Not bad. And let's look at the semiconductors. SOXX. At least it didn't fall through too badly today, but still not doing okay. FDN. Terrible. So internet stocks just completely collapsed through, gave up all its little gains from Tuesday. Okay, so that's WebL. WebL is 3x leverage, 3x leverage of that. Okay, so I don't know. I think tomorrow we'll see what happens. If I want to jump into this, I only did SOXL as the first shot here from Monday. It went lower on Tuesday, came back. Still can't decide about that. But yes, Nvidia, Tesla, for sure. SMCI, maybe. And we'll see about SOXL and WEBL with the internet. So if there is going to be a bounce, I don't know if it's going to be tomorrow. If it's not tomorrow, then you better hold off again for Monday next week, because you're essentially gambling on a budget deal over the weekend. That's rough. That's rough. Let's put it that way. Okay. Anything else? No, I don't think so. I'm not going to care about Apple. I don't think, even though it's the worst performing large tech cap so far, I don't know. It is tempting, but maybe I'll think about it on Monday. I don't think this is going to be a big play. So yeah. I think you have better chances elsewhere. Oh, MSTR. Oh, yeah, forgot about that. That one held together, actually. Even though Bitcoin was going down, Nasdaq was going down, this thing stayed flat, up 0.27%. Interesting. Very interesting. I hope that's a good sign, because I don't want to waste time for it to go back to where I bought it on Monday here. So I'm using MSTX. Let's see, how low did it get on Monday? So I probably got it around like 18 something. Yeah, $18 something cents. Now it's at 23. I don't know. Maybe this means something. So despite the bearishness so far, okay, look at bonds TLT. Okay, still in this range between 90. It has to go back up to 93. Right, pretty unsure if bonds doing good is a good thing anymore. Doesn't seem like it so far. But all right, pay attention to that. Pay attention to the dollar, and we'll see you next week, guys. Oh yeah, gold too. Gold. Let me see the GDX. Yeah, gold miners, we're back at 43 area. Okay, so we're above that 41.78. All right, so I gotta pay attention to that. SIL silver miner ETF. So we're back at the 39s. Let's see if we can get the 42 here. Yeah, gotta get the 42. EXK is my favorite for the silver miners. EXK. So we're back at $4.70, almost at $5. Should I buy more or not? Tough question. I still can't answer. AEM. Let's see, gold mining stocks. Yeah, it's made a new high. Okay, $102.68. Yes. AEM. Okay. If you really are bullish on gold, then yeah, you're gonna have to do. I would be doing the leverage. So GDXU, I would be using GDXU. 3x leverage, up 9% for the week. Okay, pretty dangerous to play it. You have to be pretty confident that it's gonna make a really good move now. Otherwise, it's just gonna be reversing back. And if it's reversing back, you got to use GDXD. Okay. GDXD now making a new low. So if you're short, you got to time it correctly. Good luck with that. Otherwise, you got to play futures on gold and silver contracts. Now, let's see. Natural gas. Okay. Boil. Back down to 85. Okay. I'll be watching this. If you're in cold, if you did buy it on Monday, yeah, you're gonna have to go through the weekend again. I'm not sure. So it's up like 13%. Not really that good, but it's all right. Like if natural gas does pull back further, it's gonna have a deeper correction. I don't know if it's gonna be next week though, or the weekend. Yeah, that's going to be a tough call. I don't know. It's too risky. It's pretty strong so far. So, if you're bearish on natural gas, you can do KOLD. I can't give you a suggestion right now. Because, like, today, it sort of looked like it was going to bounce, but then it pulled back. So, and you're going to have to go through the weekend with the weather reports. Or who knows, whatever Donald Trump says, some more tariffs on Europe or something. That might do something. So, that's pretty risky. You're going to have to get some insider information. But all right. I think that's enough for today. I don't know what's going to happen tomorrow. If anything important is going to happen tomorrow. If it is dumping, you should get out. Get the heck out. Because so far, if you look at the Nasdaq, it's in a trading range. Okay, look at the hourly chart right here. We're just stuck in this trading range. And the way it ended today is not a good sign, okay? Yeah, once it fell through here, the PPI right here, we went back down. We went back to this area we already visited on Tuesday. And it's doing that. It's probably mostly because of Apple. But that's, like I said, that's going to spill over to the other stocks. I don't think this is a good place to be in. So be careful. SPY, yep, be careful here. I'm looking for a bounce, but I wouldn't be surprised if I could get cheaper prices next week. So if this thing breaks down, yeah, I'm out. So all the stuff I was in, Tesla, Nvidia, SOXL, I'm gone. SMCI, yep, I'm gone. Right. So I'm doing SMCX actually. So let's see, SMCX. So what I got that 39-ish. So last week, yeah, 39-ish. Yeah, went to 58. Yeah, I mean, if there's a big move up, it might not happen. just yet. Might have to wait for Powell. So Powell's going to speak on Wednesday. Okay, Wednesday. That's going to be about 1 p.m. Eastern, I believe. And then you also have Bank of Japan talking late night, maybe 1 a.m. the day of. All right. So yeah, you're gonna have it. You're gonna have a lot of stuff Tuesday to Wednesday. That's about it. But I think Monday, yeah, nothing's really gonna happen. There's gonna be some retail sales. Yeah, that's gonna be like what, 8:30 a.m. I don't know how important that will be. Probably not much importance at this point. And then tomorrow we'll have at 10 a.m. the inflation expectation from the University of Michigan survey. That could be important because we got a really big number last month, and so now they're going to be really curious if that continues on this month. So it could be bad at 10 a.m. You might see something funny happen then. If not, overnight. So European stocks should be opening in a little bit. Right? It's already midnight Eastern. So yeah, they'll be open in a couple hours. You'll see. All right, guys. Later.
Feel like I should go. 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 Like I should feel like I should. Feel like I should go.